This is Bloomberg.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
The moment news breaks, no one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Earnings season is here.
Wall Street expecting a bit of an ugly season.
People may be overly pessimistic.
We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit.
Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Especially with the president, start having discussion. The path that the Democrats are going, they're going to go bankrupt. Let's sit down and find a place that we can protect Medicare and Social Security for the future generations. Let's put our house in order in how we're going to spend, and let's make the investments we need to make America stronger.
Oh, the politics of the American debt pile. My favourite, your favourite too. House Speaker
50,
Kevin
60,
McCarthy
80, 100,
and the rest, and it will continue.
Years.
Equity futures right now on the S&P.
Cornwallis hadn't even made it back to London before
by 10th of 1%. Yields lower by 7 basis points. Retail sales in America a little bit later this morning. Good morning to you. 347.57 on a 10-year. In the FX market, euro dollar 108.44. Bit of pushback this morning from one ECB official suggesting 50 is the way to go, in line with what we heard from ECB President Christine Lagarde before year-end. 108.44 and positive 0.5%. One eye on crude throughout the whole of this morning and yesterday, up 2%. 81.80, Tom.
Brent crude,
it's making a move.
87.36. Every time I look at the screen, it's pennies high.
We're having a look at 90 again. Goldman having a look at triple-digit crude by year-end. That's the story at the moment.
China opening, and Tom Hancock wrote it up about 9 p.m. last night for Bloomberg with work from Goldman Sachs that, you know what, this is what you do when you run a totalitarian regime. You're bankrupt, and you got, in a broad sense, and you got to employ people. So no shock, after the party Congress, China's opening.
I think Jeff Curry called it a bullish concoction. One thing that's just taken me aback, Tom, just to see these moves in the airline stocks so far this year in the last couple of weeks. 35% move on United. United yesterday, Tom, beat, and a raise. And a big raise too. The guidance that they put out was way, way above where the street was. And we've got another rally this morning.
We're going to talk right now about what United would do. That would be United Van Lines, moving people out of high-tech states. There are times where it's not about the zeitgeist in Washington, and it's about one strategist giving pause. Gregory Valliere does that this morning at AGF with a note devoted, Anne-Marie Horton in Washington, to the state legislatures. Valliere reporting, and this is the Washington Post, that bills will be introduced tomorrow by the left, by progressives, in California, Connecticut, Hawaii, Illinois, Maryland, New York, and Washington State to bring up the taxes and even to generate a wealth tax. They can't do that in Washington, can they?
No, there's going to be no changes to the tax laws in Washington, especially when you have a Republican-controlled House. We did have a Democrat-controlled House, a Democrat-controlled Senate, and obviously the president is a Democrat, and still most of the Trump-era tax cuts have lived through. So there's no way there's going to be any changes when you have the GOP in charge of the House. But you make the point, Tom, and Greg Valliere this morning, is the fact of the matter is these progressives cannot get any of this done through Congress. So you're looking internally, but they're going to do this and act congruently with each other across these states. This really comes from the Senator Elizabeth Warren. This comes from her playbook that you don't just tax income, you go after people's assets and wealth. And maybe it doesn't have legs, but this is something that is going to resonate with many members of the public.
The demonstrable reality is, as Greg Valliere says, get out the moving vans. Here come the moving vans, is what he says, right. Verbatim. I mean, this has been proven to Florida and other states as well.
Florida, Arizona, there has been, you see an exodus at times of people from these very high taxed cities. Think about those living in New York City. You pay federal, you pay state, you pay city tax. You have you have incredibly high rents, and then with inflation on top of that, and you compound that with the fact that you can, for most people, start to work more remotely at home. We obviously saw that exodus to Florida, and potentially if there's a wealth tax, it'll continue. I know you're laughing because you're living it.
I walked by Pharaoh's desk the other day. We never talk. I walk by his desk once a year, and he's got a map of Texas out on the desk.
I tell this story to everyone. I remember when I was moving over here 7, 8 years ago, and the accountant said they'd give me a call. Bloomberg offers great service to relocate, so I take this call with the accountant. I'm thinking, I'm going to be paying lower taxes in America. This will be great. That's
the canard.
Gets on the phone and says, federal income tax will be X. And I'm thinking, fantastic. Step down from where I was in the UK. And they said, no, we're not done. And then they start going state, city. I was like, what are you talking about?
This is so important. I'll let you go back to Anne-Marie here, John. The summation of the many taxes is
and
the
then
tension.
the property taxes on top of that. Question I keep asking is, how on earth do you retire in some of these states with the property taxes as high as
we have an announcement to make today. We do it in advance of our strategic
You're not retiring?
January 2024. Bloomberg surveillance.
What happens in 24?
From London.
Oh, is that right?
Yeah,
We're making a
Tyler
move.
Brûlé was here with Monocle. He wants us to move to Zurich.
I could talk about the taxes around houses.
Continue with Ms. Horton.
Anne-Marie, this is an administration, even with a majority in Congress over the last couple of years, that couldn't even close the carried interest loophole. What are we talking about?
Well, again, this is why these progressives, and it's a great point, they couldn't close carried interest loopholes. So obviously the private equity lobbyists got on the phone, and even they couldn't get that done because they had such a slim majority, right? Most Democratic lawmakers want to see that closed. But Jonathan, the fact of the matter is we've seen them try to undo a lot of the Trump-era tax cuts. They couldn't do it when they had the control because of that slim majority. So now what these progressives are doing are saying, okay, forget it. We're not going to work on this in Washington, D.C. We'll just take it back to our local politics. And they're doing it through state legislatures. Now, remember, this might not end up having legs, but what it does do is it is a fire in the public debate. And this is something that many people agree. They don't think the rich pay what President Biden would call their fair share. Now, I'm not talking about people who, pay their income tax. We're talking about people who've amassed a mass amount of wealth, especially over the COVID pandemic. And also comes on the heels of this Oxfam report ahead of Davos talking about the fact that there has just been this increased number of billionaires, while we're also seeing more people dealing with higher inflation, hunger around the world, and et cetera.
MH, on the latest down in Washington, D.C., that debate's not going anywhere.
She's getting so inside the beltway. You hear that?
You think so?
Just a Yul Brenner, and et cetera.
And et cetera.
And et cetera.
And et cetera.
That's just so beltway.
Very DC.
It's just very DC.
Anne-Marie, Thank you. Can we talk about property taxes? I think it's absolutely...
I think we're going to, whether I want to or
we
not.
might as well. So in the UK, and I've talked about this before on Bloomberg Radio, so forgive me if you've heard this rant before, we have stamp duty, right? So you sort of pay this tax up front, and it's not that big compared to what you have to pay annually here in America. Once that's done, you're done. And then you have council tax, which compared to property taxes is just a nominal sum, a couple of £100, depending on how big your house, how valuable your house might be and where you live. Tom, here in America, I don't think people outside the United States realize how high property taxes actually are. That even after you've paid your mortgage off, you can be paying tens of thousands of dollars a year just to live in the house you supposedly own.
And what's interesting within the urban landscape of the haves, which is the Bloomberg world, with great respect to all of our listeners and viewers, the premium you pay for grass is stunning. The difference in property taxes of real estate, like, suburbs and all that versus condos is just stunning.
It's insanity. I used to think that people went to Florida when they were older because of the weather. I worked out that's not the story.
That's a boom. And
it took me a while.
We say good morning to everyone down in Florida. And, the first person that went down this is right after St. Augustine was founded, Doug Cass. Went down to Florida.
I think you're aging, Doug.
I think it was like, it was like Grandpa Cass went down there. It was like something 80 years after the Pilgrims.
Are we doing the show from Florida? Or was it Texas? Where did you
I announced we're going to London in 2024. I can suffer Miami.
We'll try and make that happen. Simon French is going to join us. He can have a rant about this as well, if he wants. He's going to join us from Panmure Gordon in just a moment. Your equity market looks like this on the S&P. Positive 0.1%, up by almost 0.2% on the S&P 500. Disappointment from the BOJ. I don't know if I'd use that phrase. Bank of Japan unchanged, and setting us up for a really, really interesting final BOJ meeting with Governor Kuroda in March. Yields are lower by 7 basis points on a 10-year, 347.57. Tom laser focused on what's happening with crude. The rally continues up more than 2%. 81, you can call it 82 on WTI, and we're having a little look at 90 on Brent at 87.40.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Two hours away from retail sales in America, equity futures look like this on the S&P, up almost 0.1% on the S&P 500, likewise on the Nasdaq 100. If you take a trip to the bond market, quick snapshot of treasuries, 2s, 10s and 30s look like this. Yields in at the long end by 7 basis points on a 10-year, 6 on 30s. Your 10-year sub 350, 347.57. Maybe you can thank the BOJ for doing absolutely nothing and not adjusting its yield curve control. Dollar yen out to 129.34. That's a 1 percentage point move on dollar yen. It was as high as close to 3% against the Japanese yen in the dollar's favor. Need to look at euro dollar too. Yesterday, a break of 108. Just briefly, just a brief break of 108 off the back of a report here at Bloomberg that maybe we get a downshift in the next couple of meetings from 50 to 25. I can tell you we bounced back today. Plenty of speculation about whether we get that downshift from 50 to 25. The governing council member, Francois Villeroy, weighed in a little bit earlier on.
Let me remind you of the words of President Lagarde at her last press conference in December. We should expect to raise rates at a pace of 50 basis points for a period of time. Well, these words are still valid today.
Those words are still valid today. 50, 50, 50 TK, and it doesn't look like they're going to change anytime soon.
Well, yeah, that's the theme that's out there, but what's changing is everything's changing, and it has in the beginning of this blinding year. I don't know how to extrapolate United Airlines over to ECB policy, but why should ECB, other than this horrific war, be left behind? Maybe it will be better there, and that will give them some cover.
So in the near term, things are better.
Yeah.
If you listen to Goldman, Eurozone escapes recession, to Deutsche Bank,
Right.
Germany escapes recession. You listen to Chancellor Scholz yesterday on Bloomberg TV, who said himself he is convinced that
Right.
Germany can escape recession. What I want to try and understand from the Europeans, Tom, is whether the situation we went through this summer, last summer, fearing this winter, whether we repeat that act this coming summer, approaching next winter.
Someone to help us with that, Simon French, chief economist, Pamela Gordon, in the British media, particularly writing some really thoughtful essays. Simon, thank you so much for joining today. At the margin, it seems like Europe is being buffeted by good news, including China reopening. Has Pamela Gordon shifted the 2023 Euro call?
No, we haven't. We went into the year thinking that actually the behavioral response you were looking for across two parameters would play out in terms of a more dynamic behavior. What are those two parameters? First of all, energy usage, and I think Jonathan gave a good sort of tee up in terms of next winter. What are the dynamics? Well, the strongest argument for why the dynamics might be more favorable than consensus is that you're seeing quite significant behavioral change in terms of energy consumption, which there is no reason with an extra 12 months why that can't actually be amplified. And the second thing we're seeing in corporate results, not just across Europe, but you mentioned, corporate results in the United States as well, is signs now that households, which have paradoxically strengthened their balance sheets over the last 2 to 3 years, starting to divest more rapidly actually in the US. They're more the way through that cycle, but we're starting to see the data in Europe suggesting that the back end of Q4, where it was thought of a slamming shut of the European wallets, was not that path. We saw both those behavioral changes coming to pass. I think the data's on our side, but look, we're still early days. There could be a New Year hangover.
Right. Simon, we were talking earlier about the glide path on interest rates. There's an idea of disinflation, maybe ever so slight in the United Kingdom as well. There's I'm going to call it the zeitgeist understanding. In the United States, we come down, we don't know where to, 5%, 4%, dare I say 3%, maybe not 2%. Is there a consensus understanding of a disinflationary vector in Europe? I don't see it.
No, there isn't. And the ECB commentary, which you've been alluding to, if you like, reflects the national interests of the national governments in terms of how their economies may have quite different experience of stubborn core inflation, which really is going to be the headline piece of data, perhaps not on our screens each morning, but in terms of what's going to affect the ECB response function and each of the ECB governing council's decisions. So the fact that we have amongst investors a very, very different view as to whether, actually, you mentioned a glide to 543. I mean, there are quite a number of people who think we'll see active disinflation or deflation by the sort of middle part of 2024 versus those people, and I think I sit in the latter camp, who expect quite a lot of quite stubborn, quite sticky inflation because a lot of corporates are trying to rebuild margins, trying to delay the pass-through that they couldn't do in one go because of the price shocks of 2022, and therefore they're going to pass them through in 23, 24, 25 as part of rebuilding their corporate margins and a delayed pass-through of inflationary pressures.
Simon, can we talk about who's in the driving seat at the European Central Bank? I got the impression at the last meeting with President Lagarde that really felt like the Bundesbank was back in control. It was so punchy, the most hawkish I've ever heard her in a news conference. What did you make of that?
That it was going to be data dependent. Yes, it was hawkish, but as always, and we mustn't, this is far too clever an audience to fall into the idea that these are unconditional statements. For years, both when policy was left at the zero lower bound, and we were talking about when we were going to leave that, and now when we're talking about the pathway through to a plateau, through to a terminal rate, we have to recognize that statements, even one as punchy as December's, was conditional to how the data evolves. And the fact that we have now in Davos this week, and we're going to get in the run-up to the next ECB Governing Council, different takes on that data, is that, if you like, turf war going on how you interpret that stickiness of inflation and the degree to which that commentary in December persists through Q1.
There was a phrase that echoed in December. It was sufficiently restrictive. Started with the Fed. We heard it at the ECB as well. If you'd asked me, Simon, what was sufficiently restrictive for this ECB maybe a year ago, I'd say they'd struggle to get to 1, 2, not 3, because I thought this market would just completely collapse under the weight of what they were doing. Simon, that hasn't happened in the way that many people, including myself, anticipated. I guess my question to you is, first of all, why do you think that is? Is the bond market more resilient than we thought it would be? And secondly, where do you see sufficiently restrictive now with that in mind?
Well, look, that's very honest, Jonathan. Myself, I would also put myself in the camp that you are in, which I didn't see this. So we have to have a degree of humility, don't we, when we're appraising what happens next. But in terms of why we haven't seen the level of, if you like, market capitulation in the face of a rising risk-free rate, there are two things to note. One, there is a delayed pass-through. Monetary policy has famously long and variable lags. Have we seen the full impact of monetary tightening, particularly in private markets, in fixed asset repricing, the revaluation cycle? No, I don't think we have. So the jury is still out in terms of the long-term economic impact. But, and I've written quite a lot about this, and I think Tom has alluded to this in his very kind intro, is potentially a return to a higher risk-free rate has a nice side effect in terms of productivity improvement, the allocation of capital, the type of thing that has undermined economic growth. Tom, I know you've talked a lot about the impacts of financial repression on trend economic growth, on productivity. Potentially investors, and I've talked to a lot of investors who see the potential corollary of a higher risk-free rate, a return to more normalized levels of productivity, and a welcome return. That may be one of the explanatory factors.
I mean, this is really important, folks, and this centers on my optimism here on things clear, corporations change. If there's a great misjudge, I would suggest, Simon, it's led by the European, the American, the Pacific Rim consumer as well. If Pamir Gordon summed together your confidence the consumer can deliver the goods?
Well, if you take the data points in terms of the excess savings that took place throughout the pandemic years, 2020, 2021, with The US consumer has begun quite a considerable divestment phase, but they still have, while the savings ratio is normalized and will possibly undershoot, and is starting to undershoot, there is still a stock effect that can support consumer spending. Europe, and I include the UK in this, is on a much more delayed pathway. We've only just begun that divestment phase, but it circles round to consumer confidence, to sentiment. The degree to which balance sheet flex from consumers is buttressed by the fact that the labour market remains strong. You think you don't need as much of a rainy day fund for potential redundancy unemployment because you think the labour market will remain strong. Those indicators are still very robust, and that allows, if you like, a divestment cycle to support the consumer. If the labour market starts to turn, then we get a very, very different response function in terms of consumers, and we'll see corporate reporting replicate that sentiment.
Simon, super smart as always, buddy, and it has been way too long. Let's do this again soon. Simon French there of Panmure Gordon. Tom, on the latest on the European and I guess global economy as well.
There's certain core economic words that endure across decades and centuries, and he alluded to one there, which is incentives. You can't have societal incentives if you have financial repression where retirees are flat on their back. Doesn't matter what country and that. And we've identified through the great financial crisis the financial repression of so many to save the financial system. We're coming out of that. As Taleb says, the gravity is returned, and that's the emotion and the volatility you see here in early 2020.
And as we've said, the return of discipline as well.
Yes, well said.
We've talked about this a few times, and I talked about it in the last couple of weeks as well. You think about what we had over the last decade, Tom. Exceptionally low interest rates, monster bond buying programs, and we had low and stable wage pressure as well. Low and stable labour costs. And I always think about the kind of economy we built off the back of that. We invested in, what did we invest in? Cheap taxi rides, cheap food delivery.
You're on fire today.
A whole industry dedicated to just get us to do this, to just stare at our phones so they could sell commercials and all of the above. And I think we're suffering the consequences of not investing in the real world enough.
Well, there's that.
That's been the story the last 12 months.
Frankly, heading towards definitely my book of the year in economics, and it may be my book of the year. I haven't decided. There's a lot of math in it, but Olivier Blanchard really, really emphasizes this dearth of investment as an outcome of, to get to the math, R minus G is a negative number. You have created a firestorm with your foreign tax discussion.
Every time it comes up, it always
does. Love the note that comes in. This comes in from John. John, I don't know, he's on the seashore in New Jersey, and he says, Pharaoh, you'll love New Jersey, because that is the land of the property. John, thank you so much for sending that seaside in New Jersey.
Are you suggesting we should not do the show in New Jersey? Is that where this is going?
No, I would suggest John Tucker. We say good morning to John Tucker,
and to Governor Murphy as well.
Charlie Pellet of Bloomberg Radio. John Tucker knows New Jersey finance cold. I mean, he's got it down cold. He says, you look good in Summit, New Jersey.
Expensive. I think I'll take a miss. Nothing against Summit, New Jersey. I've spent a lot of time in New Jersey over the years. I just can't do the commute, Tom. Can't do the commute. The commute kills me.
Can't do it.
I can't wake up at this time and do the commute. You know, like it's got to be like a 20-minute.
Strongly agree. Full disclosure, folks, I don't even have a driver's license anymore.
Well, neither do I.
Oh, you don't have one?
You and I both. Oh. Tom, what did they say, Tom? You don't drive, you're driven?
Yeah, well, I am.
You know, that's... RJ Gallo's coming up. He's not going to weigh in on any of this from Federated
Indiana
on this market. Boiler up.
Boiler up. That's good. There's two teams, and then up north there's another team, Notre Dame or Cathedral,
Never heard
something
of it.
like that. Yeah.
No.
Yeah, Boiler Up is to the west, I believe. It's to the far west of Indiana.
From New York, this is Bloomberg.
Rutgers beat him.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy is calling on Democrats to engage in talks over raising the federal debt ceiling. Republicans now in control of the House have been demanding deep spending cuts as a price for increasing the limit. But President Biden wants it raised without conditions. That raises concerns of a U.S. payments default. The Bank of Japan gave investors a modest jolt today. The central bank kept its main policy settings unchanged Wednesday, maintaining its negative interest rate and keeping a trading ban for 10-year bonds. There had been some speculation that the BOJ would change its policy. Amazon set to kick off another round of deep job cuts. The company announced earlier this month that it was laying off more than 18,000 employees among its corporate ranks. The latest round is set to begin today. It will affect mostly the retail division and human resources. And global oil markets face a bigger surplus this quarter than previously expected, even as China reopens. According to the International Energy Agency, world supplies will exceed consumption by about 1 million barrels a day in the first 3 months of the year. The agency doesn't expect to see annual demand growth in China until the second quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
We are going to see some revisions down, but now's not the time where you really lower guidance because the economy is still okay. Ultimately, we're going to see some sort of downside. We're going to see some sort of pain, whether it's economic, whether it's earnings, or whether it's macro. What we think in 2023 is ultimately you're going to get to 4,200.
That was Chris Harvey there, the head of equity strategy at Wells Fargo, joining Tom and I just yesterday. Great conversation. He was brilliant, wasn't he?
Yes. He and Stuart Kaiser, I think, have really led an optimistic tone. Yes.
Equities right now positive 0.1% on the S&P. Retail sales in America coming up a little bit later. Tom, just briefly, crude. Brent approaching 90, 87.20. WTI having a look at 82 this morning at 1.9% to 81.70.
I think it's valid to say finally we're approaching 90 on Brent crude, John. This is the first day we can say that because it's just been relentless. 87.24 up $1.32, and I don't have a chart in front of me, but there it is. It's just that simple. Petroleum on a march, and so much of that because of China, which means it is an annual visit in Davos, Switzerland, the meetings of the World Economic Forum. Lisa Abramowitz there, just in from the piano bar. Let me get my surveillance watch out and look at the time changes. Lisa Abramowitz with one of my favorite people, Fadi B-Roll of IEA. Good morning, Lisa.
Good morning, Tom, and thank you for that. I am here with Fadi B-Roll, Executive Director of the International Agency for Energy, and there is this question here at a time when you are the busiest ever of trying to get a handle on an energy market that has defied everyone. I was speaking yesterday with Chevron's CEO, and he said he could see an argument for oil prices going to $150 or going to $50. Do you agree?
I think he's a businessman. I am sure he knows what he's talking about because he makes money or loses money, and I hope he has a good view about the markets. But when I look at the markets this year, 2023, there are many, many uncertainties. But if you ask me, which is the biggest uncertainty, I would say it is China. The reason is very simple. Last year, 2022, for the first time since 40 years, Chinese oil and gas demand declined. So it never happened in the last 40 years. And this year, Chinese economy is reopening, and we may see Chinese economy growing strongly. And if Chinese demand for oil is strong, it would put upward pressure on the prices. So China is, for me, the biggest, perhaps, uncertainty, followed by the oil-producing countries' policies.
Okay, so we'll get into the oil-producing countries' policies. Sticking with China for a moment, do you have a sense of how much energy, how much coal, how much crude they've already stockpiled to get ahead of a reopening that could potentially dampen how much activity could translate directly into demand for crude?
No, I think Chinese oil demand will definitely increase this year. The question is how much. There is no question that I don't believe that if there's a reopening of China, which goes smoothly as the Chinese leaders here and in China claim, it may mean that the Chinese oil demand will increase, unlike last year, which declined. So it means that it will be a biggest driver of the global oil demand, because when you look at it in a normal year, about half of the global oil demand growth comes from China, other half of the growth comes from everybody put together. So therefore, China's oil demand will bring about 800, 900,000 barrels per day additional oil demand growth to the markets.
You just put out a paper that said that we're actually oversupplied right now, that there is more oil than there is demand in the markets. How much would it take to change that?
Very little, because the cushion is not as big as the consumers of the world would like to see. It's a very tiny bit. If the Chinese economy, for example, surprises us on the higher side, if the economy grows instead of 4%, 5-6%, that cushion will disappear very quickly. So therefore, we shouldn't be relaxed to see that the oil markets this year will be comfortable. And without any problems. This will be more on the too optimistic side, looking from the world's consumers' point of view.
Are there any lessons taken from what we saw in the summer of last year with respect to demand destruction? At what level the price has to get to in crude where people just stop buying and there's sort of a natural ceiling?
I think it's depending on the country. I mean, it's different in the United States, different in Europe, different in India and the lower income countries. But I see that if the prices come around $70, $75, it is a good signal for the consumers around the world.
But that's a good like that they will continue to buy, but higher than that, not so much?
It's especially for when you look at the numbers, it is especially for the developing world, which is the most important one, because their financial muscles are much weaker compared to North American or the European or the Japanese consumers. I think above 70, 75, it becomes very difficult for them to absorb that increase in the prices.
Do you feel like there needs to be more investment in fossil fuel companies that have been abandoned in the past couple of years for ESG types of priorities?
I think when you talk about, for example, United States, I don't think that the oil companies have difficulties to invest in terms of availability of the money. They have a lot of money in their pocket, and I think what they have preferred, instead of investing, they have preferred to pay it back to the shareholders. And when you look at last year, 2022, the oil and gas industry, the windfall revenues reached $4 trillion US. In a normal year, normally it's about 1.5 trillion, and last year they make 4 trillion. So nobody can convince me that they don't have enough money to invest, to be honest with you. It means they don't have the intention, they pay back to their shareholders.
We've been talking about the potential for an upside surprise with respect to demand if China comes back online. What if there is a fairly deep recession or even a mild recession? How much could oil prices fall from here just because of people hunkering down and not being as active?
I think if depending on how deep the recession is, how wide the recession is, but if it's a mild recession, I don't think that we will see a big drop of the oil prices as we have seen during the COVID times. But it will definitely put downward pressure on the prices if there is a widespread recession around the world. But I don't believe that China, the largest oil importer of the world, will go to a recession. Hopefully not this year.
How do you think that the refilling, I should say, of the Strategic Petroleum Reserve in the U.S. this year, potentially starting next month, will affect pricing? Do you think that this is sort of going to be a swing factor in 2023?
I don't believe so. I believe the U.S. government will make it in a gradual manner and a careful manner so that it doesn't create a major challenge for the oil markets. And we should not forget that when the prices shoot up about over $100, the SPR played a very good role for U.S. and for the global oil markets.
So you actually thought it was a positive move?
Very much so. I believe all U.S. citizens and the entire world should be very happy to have SPRs in the United States and many other countries in the world.
Fatih Birol of the IAA, thank you so much for being with us. John, sending it back to you.
Lisa, thank you. Fantastic work, as always. You missed over here in New York City. Lisa Bramis alongside Fatih Birol there of the IEA with that iconic backdrop in Davos, Switzerland, Tom.
It's iconic. I think it's, I said to someone once, well, I think that's Italy. And I think I was turned around. I was like,
I may have been
waving
that
to
guy
Austria.
sitting
Hi,
next
Austria.
to you doing that. Do you want to pick up on a commodity story? That line from Goldman and Jeff Curry to kick off the week. Yeah. You cannot come up with a more bullish concoction for commodities right now. And he went beyond crude. Let's be clear about that.
Well, you've been out front in copper.
11,500 is the number he's looking for, Tom. Went through 9K in the last week.
And what we heard from Simon French, why is this bad news? We're reopening off of a global medical event. And to me, it's all plus, plus, plus if it gets us back to normal incentives, normal interest rate structure, and heaven forbid, commodities priced in some general equilibrium.
We're still trying to figure out, Tom, just how many issues come about from the revenge spend we're expecting from the Chinese consumer, how much power that reopening has, and whether we go back to some of the issues we were grappling with last year. I go back to the same question with the Chinese reopening on the supply side. Supply side relief, because the factories get going to full capacity again, or supply-side dislocations because demand kicks in an unfavorable way?
I would suggest there is a heritage, a cultural heritage in China to work. It's got nothing to do with the party and the politics. This goes back centuries, and they've got a work ethic like no one, and that you got to be optimistic there that they work all that out, that they work it out on a truly micro battle. Can I bring up something that Axios just publishes?
You don't need my permission.
This Chat GPT thing?
Yeah,
we're trying it for the show
week,
to get rid of me. Chat GPT passes barely what are called the national boards. They're like the CFA exam, but for doctors.
Yeah.
And the flunk rate's about, it's 14, 15, 18%. Chat GPT passed all three national
So basically, the whole of this country now is doing its homework
if you got a
on ChatGPT.
You go in, they tell you what to do.
With ChatGPT. Is that how it works, TK?
Today, a special Wall Street week from the World Economic Forum in Davos, Switzerland.
This is Bloomberg Wall Street Week. I'm David Weston.
Join Bloomberg's David Weston as he engages with the foremost business, political, and cultural leaders for discussions on wealth inequality, global power dynamics, and more. Accountability, solution-driven conversations, data insight. This Friday at 6 p.m. Eastern, only on Bloomberg Television and Radio, your global business authority.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If if you can give a new life to a building. It also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is a rally, no doubt.
The danger is we're falling into the same traps that markets fell into at the start of 22 and at the start of 21.
A little choppiness near term in our opinion, but we're more constructive on 2023 than I think most are.
Maybe we're seeing, some sort of regime shift when we see the pressures from inflation, the pressures from interest rates.
Financial conditions have been easing. I don't think you can really make much of a case right now that people are going to just spontaneously increase their rates of savings.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Retail sales data in America coming up in about 90 minutes' time. Live from New York City this morning. Good morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow. Equity futures right now up a couple of tenths of 1%, TK. We keep asking the same question. Are we rallying into a recession or rallying into a recovery?
It's right out there. Ben Laidler, always doing good work at eToro, and he just nails it, John, with a nice graphic. This is out on Twitter for Laidler, I'm sure also to his clients. This is the 7th bear market rally, and that's normal.
To be clear, he's calling it a bear market rally, though.
Yeah, okay, but that's what happens, and then all of a sudden it's not. And everybody has an interpretation of how you get there.
So Marko Kolanovic over at JP Morgan does not want to get on board with this rally. Him and the team published just yesterday.
Yeah.
Here's the top line from him. We remain cautious on risk assets and are reluctant to chase the past week's rally as recession and over-tightening risks remain high. A lot of the good news, they went on to say, is already in the price in terms of inflation moderation or the potential for a soft landing. A lot of the good news, Tom, is already in the price.
I'll go with all of that, and it's subject to change. And you say, what will change it? It's the data, and one of them is coming to us here in 89 minutes.
So you've got the hard data and the soft data. So the labour market data, payrolls, pretty decent, right?
Yeah.
The top line, headline data, great. Wages a bit softer, encouraging soft landing, Goldilocks, all that good stuff, great.
Yeah.
Look at the survey data. Empire Manufacturing
yesterday was grim.
Dreadful. The ISM, dreadful. Both manufacturing and services.
Yeah.
We've got a real gap emerging here, Tom, between the soft data, the survey data, and what's been happening with markets.
I'd go with what Fadi Birol just told Lisa in Davos, this idea that China pushes against all of this. It pushes differently against Europe. I'm with the people that suggest the China effect on Europe is underestimated. It will probably be larger. You heard that with Mr. Micklethwaite yesterday with the leadership of Germany. I mean, it's percolating right now.
We're getting the pushback from the airlines too. United Airlines beat on a top and bottom line in the last 12 hours or so, Tom. Raised their guidance. I would say shredded the guidance on the street. Stock rallied. Stock year to date, I keep saying this, up 35.81%. Year to date in a couple of weeks on one single name. The airlines have performed terrifically. You can look at the luxury names too. I was looking at the luxury names, Tom, this morning with Jamie, my producer, just year to date, up 15, 16%. Don't you have a producer?
I don't have a producer.
How does that work out? That's why we don't sit near each other. Hermes up 15, 16% this year so far. Tom Kering is up by about the same amount.
That's Gucci, right? They threw that guy out.
LVMH is flying as well.
That's that Louis Vuitton. Yeah. Got that.
Mr. Arnaud.
UAL margins before the pandemic, 17, 18% EBITDA. They're not back there yet. They got 10 or 13%, but they're well on their way back to normal. It's just going to take longer to heal.
Prices are high. Supply is constrained. We've all been to the airport. We've seen the mess. They're doing okay, aren't they? I think that's the takeaway for the airlines at the moment.
I'm just not surprised by any of this as we move along after the pandemic. The war does get in the way, particularly for
someone was clearly surprised because the stock is up by a third year to date, a few weeks in.
I think that is the China play.
I agree. Equity futures right now up 0.2 on the S&P 500. Equity futures advancing just a little bit on the Nasdaq, up by a similar amount. Yields come in by 7 basis points. Tom, just briefly, 347.20 on a 10-year, helped out by a BOJ non-decision. No move from the BOJ.
Yeah, I go with that, John. There's a knock-on effect here out of Bank of Japan, and it's a central bank that has an arch rule. This is in all the histories of the central bank, including Mr. Bernanke. They love to surprise, and if they moved on yield curve control today, that was widely anticipated, and they would not have surprised. So.
And then in March, his last meeting, how do you surprise there when we all expect
I think what you
the
see
move
is
to take
the
place in
inflation,
March
as
now?
Ben Emmons writes up, and I've quoted it 3 times off the Bloomberg terminal, top line inflation, Japan, tonight we will see that in their morning, 4% inflation. Never, John, did I think I would make that statement.
The dollar yen right now, 129, was as high as 131. A little bit earlier in the session, we had a move at 2.7%. Now only 0.7% higher on that currency pair. Stronger dollar, weaker Japanese yen on that currency pair at least. Joining us now is Laurie Heinel, Global Chief Investment Officer at State Street Global Advisors. Laurie, fantastic to catch up with you as always. Can we start with a question that Tom and I started this hour with? Are we rallying into recession or rallying into recovery?
Well, it depends. Certainly our core call is that we're rallying into recovery and that we're going to hit a soft landing, and we hope that the Fed will engineer a soft landing here in the U.S. But the jury is still out. There is still a lot of pressure on the Fed to contain inflation. Until we see those prints come down more moderately, they're going to have impulses to continue to raise rates, and they do risk leading us into a recessionary environment.
Can you find value in active management now, or do we still hide out according to theory in index funds?
Well, I think being active right now and somewhat tactical is actually serving investors quite well. We've been managing our overweight and underweight to equities pretty considerably over the last couple of months as we've watched the data and watched how the Fed is responding to that. We're currently slightly overweight equities. Places like high yield or other avenues where looking where spreads are and thinking about the future trajectory has been a good trading play. So active and in many forms, we think is going to serve investors well through this period.
What about the 2 broad consumer categories of staples and discretionary?
We're favoring discretionary right now. We heard you talking earlier about some of the areas, luxury goods, air travel, things of that nature. We think that those are more valuable in terms of the reopening trade that we're seeing in China, the impulse for consumers globally to have still the propensity to spend.
Laurie, this rally we're seeing in Europe has just been unbelievable year to date so far. Euro Stoxx 50 is up more than 10% at a close as of yesterday. Laurie, do you think that can continue? Have we got some sustainable tailwinds behind that move, or is that just a big relief rally off the back of the fact people are saying no recession, maybe the economy just stagnates? Perhaps this ECB will be hiking not into a recession, but just into 0% GDP growth.
Well, we've been trumpeting Europe for a while and have had an overweight in the equity markets in Europe while we've even had an underweight in the U.S. throughout much of last year. So we were actually thinking that the war wasn't going to weigh on Europe nearly to the degree that many thought. We were early to realizing that the energy crisis wasn't going to be as big a deal in Europe because they were taking steps to mitigate that. And as we heard earlier, the reopening trade for China benefits Europe in an outsized way. So we actually have been favoring Europe throughout the last many months now.
Is this through the luxury players? Is it through the banks? How do you play that story, Laurie?
It's consumer discretionary, but it's also financials. There are also manufacturing companies that we think look pretty attractive. We've seen autos actually be quite resilient in the face of some impulses to slow down. So there are many things to like, and it's also a bit of a value trade play because we've seen value stocks be a lot more attractive in this environment.
Laurie, what is the distinction of the U.S. juggernaut of, I'm going to say, the last 15 years versus the burgeoning EM trade. How do you study that? What is the thing our listeners and viewers should look for in saying U.S. domestic or international?
Well, again, there are a couple of different threads there. Certainly from an international developed market standpoint, we think that the short term favors non-U.S. equities because, again, that we're relatively undervalued. Sentiment is very strong there. The makeup of those forces is different than it is in the U.S. and not nearly as dependent on the high-flying growth stocks that had driven much of the past rally. When you talk about emerging markets, though, it's a very different story. We think that there are still a lot of vulnerabilities there. We actually like the China reopening trade, and so that's part of our basis for overweighting broadly the Asia markets. But there are other places where there still are concerns about COVID, there still are concerns about geopolitics, and there still are concerns about whether the long-term growth prospects remain.
Use of cash. We have the Tech Derby. John, when does the Tech Derby start? First week of February?
So Microsoft, I believe, is next week. I think we've got Netflix coming up this week.
Coming up soon.
You've got
soon
Apple
as well.
February 2nd, I think it was.
Lori, what's use of cash here? A year ago, 2 years ago, we were talking up use of cash is the be-all and end of these stocks. Now we're talking about layoffs. I don't buy the gloom of the layoff story. It's there. It's tangible. It's heartache. But how does use of cash change for the big American companies?
Well, the real question is, where do you find pockets of growth that you can invest in? And we've underinvested from a capital standpoint for quite a long time here in the U.S. We've focused more on labor, and now there's this tension between, can you continue to have cost increases? Can you continue to pass those along to the consumer? Can you continue to carry the labor if you're not getting the top line growth? And so a lot of companies are really grappling on a kind of a micro level with how do they think about that and continue to grow growth? Because ultimately, what we're all pursuing is earnings growth. And their levers are smaller and more limited than some other sectors might have.
Laurie, wonderful to hear from you. But it's Europe, not alone either. Laurie Heinel there of State Street Global Advisors. We said this yesterday, what a difference a rally makes. What a difference a rally makes. All of a sudden, the tone totally changes.
Yeah, well, I'll go with that. And we've seen that in the first 3 months here, but 3 weeks here, I should say, of the January. It's like a blur, to be honest. What was so important there is the idea she alluded to that in this tumult, there's fewer things to choose from. And that was the shock of the Microsoft news today. One of those for everybody's always, when in doubt, Microsoft. And with the layoffs anticipated and the challenges, all of a sudden, even Mother Microsoft is affected.
Markets can be painful. We'll see if this is a head fake or the real deal. Tesla this morning, up by 3.5%. We heard there from Laurie about the automakers. This was Dan Ives yesterday on Tesla. And that huge move in the last week to cut prices by 20% in some regions. A lot of investor questions about Tesla. Why is the stock up on price cuts? It was up big yesterday too. This is Dan Ives at Wedbush. The reason is because the street views this as much needed strategic poker move to go for the masses, aggressively go after consumer EV demand in a soft macro, near-term margin pain for long-term share gain volume. So our small margins are your problem, Tom. Seems to be the takeaway here for the bulls.
Technically, it's a disaster. I get what Mr. Ives is alluding to.
Been a tough time.
It's a bounce. I mean, anybody would say it's the Musk bounce, and we've seen the Musk bounce, and I should point out this goes very much between a pennant of support and resistance in late 2020 as well. They avoided with this announcement moving down to sub 100 climbs.
Do you think Lisa Shallett will push back against the gloom over at Morgan Stanley?
Don't know, but when she listens, I lean forward.
She's fantastic. Lisa Shallett, the CIO at Morgan Stanley Wealth Management, in the next hour, 8 a.m. Eastern Time.
Can you get the space heater away from me? Thank you.
7:12 Eastern, right now, live from New York. Equity futures on the S&P 500, up a couple of tenths of 1%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. U.S. Treasury Secretary Janet Yellen called a meeting with her Chinese counterpart today candid and constructive. In Zurich, Yellen sat down with Vice Premier Liu He for more than 2 hours. The Treasury Department said that Yellen looks forward to traveling to China in the near future. Inflation in the UK dipped in December for the second month in a row. According to government figures, consumer prices rose 10.5% from a year earlier. Still, inflation is 5 times higher than the Bank of England's target. The central bank has raised interest rates 9 times in a row since December 2021, and another rate hike is likely next month. In Ukraine, the country's interior minister was among those killed when a helicopter crashed near the capital city of Kyiv. 18 people died, 29 were injured. No word on what caused that crash. Twitter's daily revenue has reportedly fallen 40% in the last year. That's according to the website The Information. It also says a senior Twitter manager told staff that more than 500 of the platform's top advertisers have paused their spending since Elon Musk took over. And Microsoft is joining the ranks of tech giants that are scaling back. Bloomberg's learned that the company plans to cut jobs in a number of engineering divisions today. The layoffs are said to be significantly larger than other round of job reductions in the past year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
The moment news breaks, no one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Season is here.
Wall Street expecting a bit of an ugly season. People may be overly pessimistic. We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit. Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
There is certainly a risk to it. I mean, there is certainly, given the dynamics that we have in the U.S. Congress, there will certainly be some tensions around it, but I really hope they just get the job done and do the right thing, which is move the debt ceiling, do what's needed to make sure that this is not in question.
Gita Gopinath there, the first managing director at the IMF from New York City this morning. Good morning to you all. Let's check out some of the market price action for you. Just quickly, briefly, equity futures right now up 8 points. We're up by about 0.2% on the S&P. Retail sales a little bit later, 8:30 Eastern time, 1 hour and about 13 minutes from now. Yields look like this, down 7 or 8 basis points, 347.20 on a US 10-year. And Tom, get ready, some Fed speak a little bit later. Bostic of Atlanta comes up at 9 a.m., so that's 30 minutes after the economic data. Then you'll hear from Harker of Philadelphia at 2 p.m. Eastern Time, and then at 5 p.m. you'll hear from the Dallas Fed's Laurie Logan a little bit later.
I'll lean forward on Harker. I think he's a really interesting guy, sort of out of the Wharton Combine. He's got a real linkage here into, you mentioned the Empire number yesterday, what a disaster it was.
Dreadful.
There's a heritage of the Philadelphia Fed really having a pulse of business structure, and not just big business, but, you know, across all of the
It's an important
Philadelphia
question.
region.
How much weight should they put on the survey data that's been coming in really weak over the last couple of weeks?
It'll be important to see, and then retail sales will go beneath that headline data, important data with our Michael McKee. Anne-Marie Horton is in Washington, and she knows that in Davos there's discussion with people who are war strategists. I remember, Anne-Marie, in May when I was in Davos, a wonderful, spirited conversation with a giant, Lawrence Friedman of King's College, and he wrote in the FT yesterday on This Will Be a New and Different War. It's followed up in the Washington Post today by Mr. O'Hanlon, Mike O'Hanlon, with us many times on North Korea. Mr. O'Hanlon also talks about a new and next war in Ukraine. Within your reading, and particularly at Pentagon, Anne-Marie, how will this war change?
Well, what we really are waiting for in terms of the news on this war is whether or not Germany is going to send these Leopard 2 battle tanks. Olaf Scholz, the chancellor, would not answer that question yesterday with our editor-in-chief, John Micklethwait, when they sat down in Berlin. He will be attending Davos. People are expecting him to potentially announce whether or not Germany is going to send these or allow others to send these battle tanks because they are German-made. But Olaf Scholz said he's consulting with his allies. We know he spoke to the president yesterday. So that is something that the Ukrainians are really waiting for. They want more of this, more military weaponry. We did get notice from the Netherlands yesterday, Mark Rutte, the prime minister, confirming a Bloomberg business scoop that they will also send a Patriot missile. So you do see movement in this direction. And of course, all of this comes as the fighting is getting incredibly intense, especially as Russia is making inroads on Bakhmut. And then also, of course, today, really the topic is going to be about the interior minister who fatally died in this helicopter crash.
Yeah, what's important here, and again, to go back to Professors Friedman and Dr. Hanlon, the idea of Friedman talking about it is a winter stalemate. And Michael O'Hanlon saying the days of incrementalism, which, Anne-Marie, you've reported on from day one, they're over. Do you buy this? Is this being discussed, that we move beyond stalemate and incrementalism?
Well, potentially, but I mean, what I think you will see when everyone talks about is this protracted war, that this will just continue. I mean, and I think we've talked about this a lot. What we saw in Ukraine before this started, and not everyone always paid attention to, was 8 years of fighting in eastern Ukraine.
Yeah.
What is difficult at this moment is it doesn't seem like the Russians want to negotiate any sort of ceasefire, and Russia will not leave without that land that they've already technically, in the Russian doctrine, annexed, right? Like they say that Luhansk, Donetsk is theirs, as well as Crimea. And this is a no-go for any political leader in Ukraine.
Tell me, let's bring it back to the domestic front right now, where MAGA reigns supreme against the newly minted speaker as well. What is their power to dictate our incrementalism on Ukraine?
Well, of course, Kevin McCarthy made that famous saying when he said it's not going to be a blank check for Ukraine, right? He had walked that back, though. At the moment, what you do see is more military support and aid going to Ukraine, whether it's a Patriot missile, whether it's the Bradleys, the tanks that are going to Ukraine, which, by the way, these tanks, when they were developed, were actually a response to the Soviet tanks, the BMPs, which stand for, in Russian, just infantry fighting vehicle. These tanks are basically one for that Soviet era. But the United States obviously cannot do this alone, which is why you see calls from the UK sending tanks, from France, and obviously the one we're waiting to drop is Germany.
Anne-Marie, if we could just finish on the latest from the Treasury as well. There was a meeting this morning between Secretary Yellen and top economic officials out of China. The Chinese Vice Premier, when you hear this readout and this line, because I've heard this line a lot, when you hear this line from the Treasury, so this is the readout, so-called readout from the US side, Yellen had candid and constructive conversation with the Chinese Vice Premier. What does that mean?
It's a good question. It feels like there's a lot of abstract or maybe word salad being used here. But I think, Jonathan, you brought this point up yesterday when we heard from the Vice Premier Liu He in Davos talking about a China that doesn't want to see protectionism. I imagine the, quote, candid words Secretary Yellen used with China was about that. Also, very much so on her mind is debt relief for Africa, especially in places like Zambia, and that is going to be a key part of her trip coming up. The last line of the readout, I think, is incredibly important. Secretary Yellen welcomes her upcoming trip to China. So not just Secretary of State Antony Blinken, which we know yesterday will be now going to China in early February, Yellen will be at some point heading to Beijing as well.
AMH spending a lot of time in Beijing at 23. I think is the takeaway.
Yeah, I do. I feel that very strongly.
Road trip.
Yeah, you know.
Anne-Marie, thank you. Down in Washington,
Trips
D.C.
plural.
Just to get you set up for the day ahead, it looks like this, 8:30 Eastern Time, retail sales in America. After that, and just before it actually, we'll catch up with Bob Michael of JP Morgan Asset Management, Veronica Clark of Citi as well. Really looking forward to that conversation as Citi continues to make the push, led by Andrew Hollenhorst, their chief economist, that we're going to get more hikes, Tom, and we underestimate how far this Federal Reserve is going to go.
Well, you talk about the strategists, and there's the optimists and those less optimistic. What I see pushing against it right now is a VIX, which acts differently today than recent days, 19.15 to get down to an 18 level is not noteworthy, but there it is, 23 down to 18 within Ben Laidler's 7th bear market rally.
19 right now. Do you want a flavour of where Bob Michael's at over at JP Morgan?
Please,
really
always.
interesting print interview here at Bloomberg with him just yesterday. It is possible the Fed will not initially do enough because the labour market proved more resilient. That's his takeaway at the moment. This is the one thing that can unravel the market, and it's my biggest concern. He went on to say inflation does not come down until wages do. Wages don't come down until unemployment rises. Unemployment does not rise unless we are in recession. Bob Michael at JP
That's a
Morgan.
classic Bob Michael. Like, he's sitting with Diamond, briefing Jamie Dimon on this for Diamond's annual letter. And everybody else is like, bad news is bad news, or good news is bad news.
Sure, whatever.
Michael is like, good news is bad news is good news is bad news. That's the Bob Michael approach.
Well, I think after the payrolls report, we got this sort of idea of this immaculate disinflation, that maybe we can get wages come down and unemployment doesn't need to climb. I wonder if that's just a quirk in the data right now that resolves itself in the coming months.
My problem with this is, first of all, it's by definition nonlinear, and we don't know the nonlinearity of that. But far more, John, it's a step function. You come down from the horror of where we were X months ago, and you get to a certain level, and then you recalibrate, you re-hedge your bets there, and those levels, I think we have a clearer idea of those levels here than versus what Simon French said about Europe. They don't have a clue on those.
My frustration with this conversation at the moment around the recession, I talked about this yesterday with Troy Gayeski of FS Investments and AllianceBernstein's Gershon Distenfeld. We keep talking about recession as some kind of binary event, this line in the sand. You don't cross it, everything's okay. You do cross it, everything's terrible. It's a process. We've got to sort of throw out that word and talk about what we actually
should throw
mean
out
by
the
it.
amateur interpretation of that word, and I say that for the late Martin Feldstein.
Precisely. RJ Gallo's coming up. Looking forward to that. He joins us from Federated Hermes.
the innovation agenda is going full speed on mitigation. That's where, there's 100 companies, Breakthrough Energy's funded. There's
by mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come out. So that's the package that you're talking about mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, now 4% of new cars are electric, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
Equity futures trying to bounce this morning. Good morning to you. Here's a flavour, a snapshot of the price action. Stateside. Equity futures look a little something like this. Stateside? You don't like stateside?
No, it's just,
which side of the Atlantic do you prefer?
Just say the colonies. Here in the colonies.
How do you think that's going to go for my career in America?
We're going to get revolutionary here with RJ Gallo. Keep it up, John. Give me a data check.
You said that, not me. On the NASDAQ, up 0.25% in the bond market. Your 2-year, 10-year, 30-year shaping up as follows. On a 2-year, yields come in 3 or 4 basis points. 416.45 on a 10-year. We come down 7 basis points, 347.20. And maybe you can blame the BOJ this morning and Governor Kuroda for doing absolutely nothing with their yield curve control, setting us up for maybe, and I say maybe, a move at his last meeting at the Bank of Japan in March. Dollar yen, 128.94, way off session highs. Through 130 a little bit earlier, so yen weakness still, but way off where we were. 128.90, that currency pair positive 0.6%. Euro dollar yesterday, a brief break of 108 off the back of speculation, and a story here at Bloomberg suggesting that maybe we get this step down from 50 to 25 in the next couple of meetings. Some pushback this morning from one ECB official, 108.32 positive there, 0.4%. That right there is a stronger euro and a weaker dollar on euro dollar. We are 1 hour away from retail sales data and factory gate inflation data as well. PPI expected to slow in the month of December. Federated Hermes and RJ Gallo weighing in, saying the following: inflation will keep trending lower in 2023 from its still elevated levels. Declining goods prices, improving supply chains, lower commodity prices, a strong dollar, that's interesting, benign inflation expectations, slowing growth and moderating job growth, Tom, should drive down inflation.
Certainly the trend that we see right now from the U.S. economy and, frankly, on a global basis as well. Gita Gopinath talking that up at Davos yesterday with Francine Lacroix on an important panel as well. Joining us now is Mr. Gallo. He works with Stephen Auth at Federated Hermes. And what's important here, R.J. Gallo, is to know that when you work with Steve Auth, you've got a long-term perspective. You lead your note by saying, guess what? It was the worst year since 1788. And you are guaranteeing us 1789 was better than 1788. If we go back there, the great common feature of 1789 was the Red Sox still needed a shortstop. That was the linkage back there. You can tell that to Steve Auth. RJ Gallo, what are we going to do here this year? If it was grim last year, 60-40 died. Does 60-40 and does your bond market recover?
Well, good morning. I think the answer to that is yes. The disaster in the bond market last year was profound. You got to go back hundreds of years, as Tom just mentioned, to find a period when treasuries performed as poorly. We think that this year is shaping up to be much better. As you noted in my piece there, inflation is on its way down. The economy is slowing. Earlier in the broadcast, Jonathan was talking about the soft data, the services-ism, for example, flashing signs of yellow, if not red. All of those factors should suggest that high-quality bonds will produce positive returns after the double-digit negatives of last year. That is very helpful for diversified investment strategies. A 60-40 has always been built on the idea that bonds and stocks don't move together. Last year, they moved in lockstep. So now we think diversification will start working for us again this year.
If that is the case, and we're investing for total return as well, a lot of it's already been done. What will be the forces that keep this train going into the year?
The bond market started off with a very favorable tone. Fortunately, our expectations are coming forth on the tape, if you will. I don't think, however, that's all we're going to get. One thing about fixed income, and this is the boring part of fixed income, it's the income. It's the fact that you get a yield that each day accrues as each day ticks forward. That doesn't happen when yields are close to zero. But now that yields, the 10-year Treasury is between 3 and 4. You have corporate bonds that can yield 5 or 6. Munis are much higher in yield. You actually get an accrual of income that supports your total return. You're no longer just banking on price changes. When yields were extraordinarily low, 2020, 2021, that's all you had. You had to have prices stay high or else you were going to be decimated. And ultimately we were. Now bonds are returning to a somewhat more normal state where the income matters for your return profile.
Frame in here the great debate that we're having this morning, and that we come in, we disinflate, and there's going to be a point along the way where maybe we stop disinflating. What happens at that given point where we say, okay, now the really heavy work to get back to 2 or 3% begins? How will markets respond at that nexus, at that break in the curve, that kink?
Well, I think in the last 20 years, we've almost become trained to expect that turns in the economic cycle are dramatic. The global, the global financial crisis being Exhibit A, and the COVID disaster being Exhibit B. In other words, we haven't had sort of a typical recession in quite a long time. We anticipate that this will be a more typical recession where the Fed's extraordinary tightening of monetary policy slows the economy, disinflates, as you mentioned, and that they don't have to respond by driving target rates back to zero. In each of those last two examples I just mentioned, that's what happened. Target rates went to zero, turn on the balance sheet expansion. You go from, it's like almost a binary state. Everything's okay, everything's a disaster. We don't think that's going to happen this time. We think that there have been recessions in modern history, 1991, 2000, 2001, when, it was challenging, but you didn't have target rates going to zero. You didn't have double-digit rates of unemployment. Something like that is apt to happen this time. And so markets don't have to crash, don't have to surge. Bond market returns are going to be moderately positive this year. That's what we believe. Moderately positive does not assume that the target rates go to zero. So the markets are going to have to behave in a more normal fashion than what we've seen in the last two crises.
So let's go back to the top. You're a little bit more constructive. And the lead line here that I think underpins all of this, the foundation for some of this constructiveness, is inflation will keep trending lower in 23. Now, RJ, you went through a list of things that you think will go in that direction. You said declining goods prices, improving supply chains and lower commodity prices, and a strong dollar. How does China's reopening push back against a few of those things?
Well, the commodity prices is the one, as you were reading that, I was like, well, the commodity prices is the one to really keep your eye on. Things move fast these days. Commodities disinflated, declined pretty sharply last year, certainly helping the disinflation story. China's abandonment of zero COVID has been a stark reversal from the multiple years that preceded. The markets, and certainly we, were surprised to see how quickly the Chinese authorities walked everything back. And there's no doubt that should boost commodity prices. However, there's a favorable element from China's reopening with respect to disinflation. That is continued unkinking of global supply chains. Getting more Chinese factories up and running, more people back to work once you get through this very difficult wave of illness is apt to continue to support the disinflation story, even if commodity prices are likely not falling, and as we've seen so far in 2023, actually rising, as for example, oil. So I do think that the China reopening story it's not a single variable. It has effects that should boost commodity prices, but also should help with the disinflation process with respect to supply chains and production.
What does that mean for goods prices, RJ? Forgive me for jumping in, but what does that mean for goods prices? Because I think a lot of people looked at the goods disinflation over the last couple of months and started to get comfortable with the idea that some of that is becoming entrenched. I just wonder whether the China story leads to further goods disinflation because factories reopen in a more material way, or whether we get a return of goods inflation off the back of the burst in demand we're expecting.
It's a great question. I think the uncertainty is high around this. On net, those at Federated Hermes who specialize in watching China, we think that some of the ebullience about the economic response of the reopening story and what that might do to global growth and what that might do to inflation is a little overplayed. The ability of getting China back to work, to smooth out these supply chains, that's a key variable. One of the main challenges that prompted the global inflation story had to do with production interruptions and supply chain kinks. China coming back online is obviously going to help that. I think on net, yes, inflation is not going to get sort of the single benefit of the reopening story. But on the other hand, we think that that part of the China reopening is being underplayed. Obviously, this is an uncertain time. When in world history has an entire economy gone from COVID zero, call it attenuated production, to re-entering the global supply chain and global economy as quickly? We don't have a lot of history here. But I think on net, we're still optimistic that the disinflation story takes hold and goods prices don't have to rebound sharply because of China's reentry, because they make a lot of the goods.
It's happened twice, Tom. It's happened twice, and all in the last 3 years. That's the issue right now. That's why the next year is so uncertain. We've had the reopening of the United States and Europe. Two major economic regions, and China stayed shut down. And we had all those problems, and I think we sat here a million times and we said, can you imagine if China reopened at the same time as the US and Europe? How much more problematic that might have been with the commodity issues we experienced.
I give credit to a lot of not China optimists, but what I would call almost China realists who are politically attuned to the be-all and end-all, and I give Richard Haas immense credit on this, that they had to get through the party Congress, and the morning after the party Congress, things started changing. Bang.
Well, things changed with the protests as well. Let's not forget that. We had those protests across the country.
Yes.
Then all of a sudden, I mean, they'd never say that it was off the back of the protest.
But the elephant was the party Congress.
Pretty clear. RJ Gallo, thank you, sir.
RJ, brilliant.
A Federated Hermes. So much.
It's great there in 1789.
Just to really, do you remember that?
I do. Well, I don't remember it. It's like, that's when Cornwallis was on his way back to London from the colonies.
You've seen the latest read from Citi and Andrew Hollenhorst. We'll catch up with Veronica Clark of Citi just after the retail sales report in about 50 minutes.
Really important note, and this is, of course, something that's very germane to New York, where we've had nurses' strikes, and this is something percolating out there, which is what does the medical industry, the medical section, 1618, dare I say 20% of the American economy, what is a disinflation tendency there? You got to be kidding me. There is none. There's going to be a payback for COVID, and you saw it with the nurses, and Hollenhorst says, beware medical service inflation.
The last time I heard from Citi, they were still leaning towards 50 from the Fed at the next meeting.
Yes, I think that's right.
I think the rest of the market going in the direction of 25, but we'll catch up with Veronica in the next hour.
47 minutes.
So the next hour looks a little something like this. We get retail sales at 8:30, a whole bunch of data in about 50 minutes. Then we'll catch up with Bob Michael just before and just after from JP Morgan Asset Management, and then we'll get the view from Citi. Fantastic lineup in the next 60 minutes right here on Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy is calling on Democrats to engage in talks over raising the federal debt ceiling. Republicans, now in control of the House, have been demanding deep spending cuts as the price for increasing the limit. But President Biden wants it raised without conditions. That raises concerns of a U.S. payments default. The Bank of Japan gave investors a modest jolt today. The central bank kept its main policy settings unchanged Wednesday, maintaining its negative interest rate and keeping a trading ban for 10-year bonds. There had been some speculation that the BOJ would change its policy. India may have already surpassed China as the most populous country in the world. According to the World Population Review, India's population was just under 1.42 billion at the end of 2022, and that's a little over 5 million more than China. On Tuesday, Beijing reported the first population decline since the 1960s. Mortgage rates in the U.S. fell to a 4-month low last week. According to the Mortgage Bankers Association, the rate of a 30-year fixed loan fell 19 basis points to a little more than 6.2%. And that helped applications soar by almost 28%, although the data can be a little volatile around the holidays. Amazon set to kick off another round of deep job cuts. The company announced earlier this month that it was laying off more than 18,000 employees among its corporate ranks. The latest round is set to begin today. It will affect mostly the retail division and human resources. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
I'm absolutely convinced that this will not happen, that we are going into a recession, and we showed that we are able to react to a very difficult situation. I think no one really expected that we would easily survive a situation when there would be a complete stop of the supply of Russian gas to Germany and Europe, but we succeeded.
The German Chancellor, Olaf Scholz, speaking with Bloomberg Editor-in-Chief John Micklethwaite there in Berlin. Can we just sit on that just for a moment, Tom? I totally agree. If you told me a year ago what would transpire, if you told me that invasion would take place and that ultimately Russian gas would be cut off to Europe, this is not the winter that I expected. It's not the winter that I don't think anyone expected. And even 2 months ago, I think we were all absolutely convinced that we'd get that recession for the Eurozone as a whole and for Germany in particular. And now we're dumping those calls too.
Yeah, the weather thing's there, and I'm not going to comment other than to say what I observed today in the press, which is a long winter. Winter anywhere goes out to March.
And we've got next winter too.
Yeah, I'm not there in the all clear weather angle. What I would say, and this goes to Michael Hanlon in the Washington Post today, who's truly expert on this. There's no stalemate. Lawrence Friedman of King's College talking about it too. There's no stalemate. The war continues in the winter.
Javier Blas said it as well, a Bloomberg opinion.
Yeah.
A lot of this was luck. the weather turned out to be far, far more in the Europeans' favour. And I'd go further, Tom. I've said this yesterday a few times. There is a difference between good and bad and better and worse. This was better than expected. No one thinks this is good in Europe right now. I don't think anyone living in Europe thinks this is good right now.
We want to synthesize this right now, and we will do that with someone who should be in Davos. And let me tell you, he'd bring the bar at the hotel there, the Belvedere, to a halt. Damien Sassower briefing CEOs on the reality of emerging markets. He is definitive with Bloomberg Intelligence. Is the China recovery for real? Ed Hyman says 6.1% GDP. Others are all of a sudden percolating. Do you buy it when you look at broad EM statistics?
Well, just look at the GDP data, right? I mean, everyone was calling for full year 2022 GDP in China to be under 3%. They somehow got that extra 0.1 of a percentage point to make that 3%.
Do you see that as Indonesia data? Does Indonesia data confirm the enthusiasm over China?
Well, it's not Indo. It's going to be Thailand and South Korea first and foremost. But we do see central bank activity tomorrow from Indonesia, and they are expected to hike rates by another 25 basis points. So Asia, which is a little bit behind the curve, and Malaysia as well, is expected to hike by 25 tomorrow. So there's some activity going on in emerging markets. But if you look at EM currencies as sort of a proxy for what we've seen this year, I mean, it's been nothing short of spectacular. Asian dollar index, which we got pretty constructive on at the end of last year, is up almost 3% this year. I mean, every EM currency, I think with the exception of Peru and Turkey, Jonathan, are up on the year and up big. Thailand and South Korea up almost 5%.
If I'm a mere mortal and not some fancy guy like Damien Sassower, how do I express EM enthusiasm? Which ETF, which asset class is the proper way to express EM enthusiasm?
A lot of people out there are going to love this. FXI, which is the China ETF that everyone's been buying hand over fist right now this year, I think is up 11% this year alone after being off something on the order of 30%.
It's got room to move?
I mean, look, on low liquidity, I mean, relatively light volumes, yeah. I mean, it doesn't take a lot to move the needle. And I guess that's been a big macro call.
FXI.
Yeah, I'm not calling it. Look, I'm not a believer in it. I think it's gone too far too fast.
Here. Okay, I got to trade.
Well, I think you touched on something that slipped under the radar as you joked about where did that 3 handle come from on China GDP. I'm not letting it go. A lot of people looked at that data and thought, yeah, whatever. They're going to tell us whatever they want China GDP to be. And guess what? I'm willing to look through whatever that data looks like for the next couple of months because I expect that data to get better. Yeah. That's the view of most investors right now. How much better do you think that's going to get? And do you think it lasts very long?
So for me, the real data points you got to look at are the credit markets. You got to look at AT2 data out of the China banks, which now you're seeing them. They're not going to make their capital. Like they're threatening to not make their capital call. So basically, there's all sorts of things going on in the credit complex around the property developers, around all these defaults, around Evergrande or Hallrung. By the way, if you look at Country Garden bonds, they're up 30, 40% this year alone already. I mean, it's been an absolute moonshot for all of these high-risk, high-volatile asset classes on light volume.
Was it just a pure and simple bailout by a totalitarian regime?
I think it's light volumes, low liquidity, and so, it doesn't take a lot to move the needle. What we've learned from all of this, Tom, is I don't know where China fits in your portfolio, but it's not zero, right? I think that's the reality of where we are. I don't agree with a lot that's going on. I don't agree with the numbers. I don't put a lot of stock in them.
Where China fits into my portfolio?
Data.
Royal Dalton. Continue, John.
Well, let's talk about the revenge spend we can expect.
Property taxes.
Airlines are flying. Yeah. Luxury goods players are absolutely flying. If we were going to have this conversation a month or so ago, I would have said that the China that was reopening is not the China that shut down, that the consumer is more nationalistic. We're seeing the barriers to entry for the property markets in Canada go up. Ron DeSantis, the governor of Florida, wants to do the same. I just wonder where this Chinese money is going to get spent, how this capital is going to be deployed this time around.
How sticky is the money? And what happens, by the way, if the capital controls go up? I mean, that's the real concern, right? You've got voyeurs coming into the market right now, speculators, effectively. That's the first money that comes in. And what happens if things go horribly wrong, as you say, right? I mean, they're all going to head for the doors. And what happens then? Does Beijing basically put up the gates again? And that's the real risk when you're investing in any emerging market, more or less China, which has got a managed currency. I don't think that's going to happen. So, look, if you take a step back, it's the China New Year. We're setting up for the Spring Festival. A lot of people, I'm a year of the tiger. It's the year of the rabbit. You know who's the year of the rabbit? A lot of people mistake me for Brad Pitt. He's a rabbit. Albert Einstein's a rabbit. Sting, George Michael, they're all rabbits. It's going to be hopping around.
I've never heard of this. I didn't
Shifting
know
gears,
that. You
shifting
should
gears to save the show with Damien Sasso. David Papadopoulos is our surveillance bookie on horse racing. Other than that, it is Sass Hour. There's no other discussion, and it's not Cowboys to the Super Bowl. Can we have real football talk?
Lamar Jackson to the Jets. Lamar Jackson will come to the Jets. 50 million.
Giants, Eagles.
Giants,
Eagles.
Danny Dimes. I mean, it's Saquon Barkley. Woo-hoo-hoo. Look, I'd love to see the Giants win that game.
They can take on the Giants in those lines.
I think it's going to be a close game. The NFC East has been a very, very tightly fought division all year long. Yeah. So, and Dallas is still in it too. I mean, I think that San Francisco game is going to be good, but I love the way Danny Dimes is playing. I mean, Hurts is really not fully back in the mix, but, you know, they've got, I mean, look, it's Philly, right? They got A.J. Brown. They've got Devontae Smith. They've got a pretty potent offense, and they've got a tough defense. It's going to be a tough call for Big Blue.
Can we talk about personnel, the future of two individuals? Aaron Rodgers, Mr. Brady.
Yeah.
Where they're going next?
Wow.
They're going home retiring, or they're going to different
Again, I'd
teams?
love to see Aaron Rodgers in green, in New York Jets green, but Tom Brady, this one looks ugly for him. I don't know if he's recovering. I don't know if he's going to come back next year. I don't know. I think if you ask, you know, most people out there, they probably think this is it and he's going to hang it up. But, you know, Aaron Rodgers still has some life in him, and I'd like to see him move. I don't think that the Packers are going to let him go.
I flew back from Davos a couple days ago, and there in the promenade was the Man U. The Glazers had the Man U little shop there next to where you buy the Pateks
and the flags.
Yeah, whatever as well. Is America going to buy with the Middle East? Are we going to abscond with Premier League football?
Abscond, meaning are we going to enjoy it, bring it, like, and the U.S. is going to embrace it? I think it has. I think it's happening.
Who owns Newcastle?
The Saudis right now.
The Saudis.
Yeah, no, I think it's happening. I think if you look at some of the, I mean, Lisa did a great interview this morning with the chap from Bain, right? Who owns yeah. And so my point is, it's expensive because U.S. owners want to run the team profitably. Middle Eastern owners, you know, it's kind of, they don't care about profits.
Let me ask somebody who's knowledgeable.
Yeah, please.
What do the Kansas City Royals of the Premier League do? How do they respond, 5 or 6, 8 teams, to the madness Damien's describing?
Can I tell you what's interesting about what's been happening with Chelsea and Mr. Bowley, who is American and has experience, I believe, with the Dodgers? He's putting players on 7-8-year contracts, which a lot of people are discussing because traditionally in real football, you have a 4 to 5 year contract. Right. And that can go one or two ways. It can go in the player's favour because they get better and they can demand higher wages or they can demand a transfer. Or it can go in a team's favour because you can just get rid of them after a couple of years if they're no good. These baseball contracts are much longer. We're talking like decade contracts. And bringing that to real football could be pretty interesting. So there is a change emerging, I hear, from US leadership who are trying to run these clubs a little bit differently. You take a young player at 20, put them on an 8-year contract, and over the average of the contract, you end up paying them less than maybe you otherwise would.
No, I think that's smart. I think that's exactly what Major League Baseball has introduced. But the NFL is very different just because of the violence of the game and the activity. So, you know, it's a health issue, I think. But I completely agree with you. I see football players getting paid, you know, long duration contracts. Absolutely.
Jim calls in from a foreign exchange pit and says, ask John who's going to buy Man U.
Don't know.
Is that like percolating?
I do wonder. I think the Liverpool transaction is more interesting. I wonder if Fenway Sports are looking at this right now and just thinking, it's time to go.
Henry.
Made the money.
John Henry.
Let's get out.
He's always early.
Don't you get the feeling that they don't think that this is, you know, things are maybe a little bit toppy?
Totally.
Take the Middle East money.
I take the Middle East money. Take what the market gives you.
We got through this tots free. I thought the whole thing was to get Damien and Seth to talk about the tots.
Didn't talk about Rafa Nadal either. Out of the Australian Open.
Bloomberg Surveillance
Sports. Drop by to do a sports segment.
Damien Sassower, thank you so much. Futures up 14. Good morning.
Lisa Shallett of Morgan Stanley up next.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies. And I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted these subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
A special Wall Street Week from the World Economic Forum in Davos, Switzerland.
This is Bloomberg Wall Street Week. I'm David Weston.
Join Bloomberg's David Weston as he engages with the foremost business, political, and cultural leaders for discussions on wealth inequality, global power dynamics, and more. Accountability, solution-driven conversations, data insight. This Friday at 6 p.m. Eastern, only on Bloomberg Television and Radio, your global business authority.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
It feels like you've got conflicting signals coming at the moment, a muddled outlook for many.
Should we start to see a recession come into the fore where that's the critical concern?
Is it a mild recession or is it something worse? I think mild recession is the word you're hearing quite a bit over the last few days here.
We think we're really facing more of an economic malaise than we are some sort of sharp recession.
The composition of growth is improving, right? So even though inflation is moderating, real economic growth is accelerating.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz in Davos, and Tom Keene. We welcome all of you here. An important report on the American economy, retail sales in 30 minutes. John Farrow, it's just flat out an inflation guide, a consumer guide. It matters to the Fed.
Just how strong is this economy? Because right now this market's rallying into who knows what later this year. Is it recession or global recovery? Tom, you look at the hard data and things are pretty decent. You look at the soft data, the survey data, things look pretty terrible. Empire Manufacturing yesterday, dreadful. The ISM in America, yes. Manufacturing and services, not great. And that's the debate right now for a lot of people. Are we coming into a year dominated by a growth slowdown off the back of monetary policy tightening, or a year where we get a global recovery off the back of China reopening?
We did Bank of Japan earlier, but I'm going to show the elephant in the room here, John, against these important micro data points, including what we see in 28 minutes, and that is the elephant at the World Economic Forum meetings, optimism from China and their leaders that they're back on the page with the West.
And back to normal, and optimism in some of these stocks as well. Luxury players in Europe, ripping. Airlines in America, what a rally.
High yield,
up
ripping.
35,
Bramwell
36%
mentioned that before she
on United.
left us.
You mentioned credit. High yield spreads tightened by what, 60 basis points so far year to date, the last couple of weeks.
Right.
So high yields rallying as the ISM drops below 50. Something's got to give.
Right.
Either the survey data bounces back or credit spreads need to go
I strongly
wider.
agree with that within the hard and soft data, but what's important, and this is with retail sales, price matters, and one of the great mysteries here was that inventory overhang across all sorts of categories of retail sales, and price reacted. Shock, they move units. That
So
may
that's
be what
the
we
goods
see.
disinflation that people hope continue, and they hope it spreads to services later this year. We'll see how sticky that is. Is there a challenge emerging to the goods disinflation story now off the back of China reopening? That's an additional fly in the ointment too.
Right. One of the important points here is the microdata. Damian Sassower, as he left us in the set the last hour, notice, John, Liverpool swag is on sale. It's been that bad of a season
that why Bob Michaels
for
wrote that?
Liverpool. That could fold right into retail sales in the United States and the United Kingdom.
Bob Michael of JP Morgan Asset Management alongside us. Great to catch up with you, Bob.
Great
as
to catch
always.
up.
Should we save Liverpool for later in the conversation?
Please,
Do you want to
please,
start with
please.
markets? You had an interview with Bloomberg News yesterday. It was really, really interesting about the risk that maybe this Fed does not do enough. Can you talk to us about that risk?
Yeah, I can't get 2006 out of my mind. The Fed had raised rates from 1% to 5.25%, 425 basis points. Here we are today. They've raised rates by 425 basis points. And then they stopped. And was it enough or wasn't it enough? It took a while for things to slow down, and ultimately it ended in the financial crisis. But they got to 5.25. We're still at 4.25. Will they get to 5%? I think there's still a lot going on. The labor market's tight. China's reopening. The housing market, although prices are coming down, the competition for houses is still very, very high.
So how conservative are you when it comes to this rally that we're seeing emerge in the last couple of weeks, the last few months?
Well, we've been part of it. We thought at the end of last year the markets were ripe for a rally. I was out meeting lots of clients in a lot of places, and a lot of them were telling me they're going back into the bond market for the first time in a while. And they didn't mean a year. A lot of them meant for the first time in 7 to 8 years, but a lot of them were saying this is the first time they've been in the bond market since the financial crisis. So there was a lot of money desperate to get into bonds, waiting for high real yields. They got it. It's come in. The Fed's thrown a lot at this market. They're probably ripe for a pause. I think the market runs a bit more, and then it pauses when the Fed pauses.
I want to go back to 2006 and your observation pre-GFC. And what's so important to me, and this goes to, without question, the observation of the year last year, Nassim Taleb saying the gravity has returned to the system. All of a sudden, the dynamics harken back to 2006. And what I remember then was the overshoot in real estate. It was hugely advanced, hugely inflated. Down we came and overshot through the log regression. Are we going to see that this year with bonds where the yields, the price moves so much that we overshoot in certain ways?
Well, the overshoot in real estate occurred because the ample supply of pretty much low-cost money was around everywhere. And that's happened over the last couple years. So that costless liquidity has been sloshing around for a few years, and we've only recently started to remove it from the system. So, yeah, I do get concerned that there will be an overshoot. We do get concerned that there are bubbles out there that will burst. It's really hard to identify them. But the one thing we're pretty sure of is the only way this ends is with the recession. You have to have a recession to really cool things down and reset.
Amber Evans featured at the Telegraph yesterday with Ken Rogoff. Lisa Bramwood's talking with Ken in Davos, and Ken Rogoff made clear this is a different shadow bank than 2006, but nevertheless there are shadows within the banking system. How does that devolve into JP Morgan fixed income?
Well, by definition, shadow banking is shadowy. So we need to be concerned.
Should we quote on that?
We can, yeah.
Yeah, we need to be concerned about that. But there's a lot of shadow banking that's occurred in the private capital markets that have financed a lot of things that may have made sense 2 or 3 years ago. Do they make sense today? Are there write-downs coming there? Where will those write-downs occur?
Are there write-downs? Is there excesses within private equity?
I think we look at private capital in total, and we look at a lot of the private credit transactions. For sure, there are going to be restructurings, exchanges, write-downs.
Is he talking about Man U?
I'm not sure. I don't think so, given that's a public company. Yeah. Can we talk about how what's happening in private markets could introduce a new set of risks into public markets? I'm told repeatedly, you are too, that high yield is stronger, that the quality is much higher than it was maybe a few years ago, 5, 10 years ago, especially in the last decade. Bob, do you push back against that, knowing that there is this risk here in private markets that could spill into public markets?
So I've heard those arguments before every single recession. This time, high yield will hold in. We have to remember, really, the high yield market got started in the 80s when it became public and investors could get invested in it. So it's not been around for a long time, and there have only been a handful of recessions. Every single time headed into a recession, it holds in well because this time is different. And every single time in a recession, credit spreads blow out to a minimum of 800 over. And yes, it may look higher quality, but when defaults start to hit, when the economy goes into recession, when corporate profitability comes under a lot of pressure, investors will reprice that market. The one thing that I worry about this time that is genuinely different is the amount of investment in the private credit markets. And if you start to have problems there, where you start to get restructurings, defaults, exchanges that are in the 20% neighborhood, investors in those spaces may only have the public markets as their relief valve.
You sell what you can, not what you want. Ultimately, the feature of what we could see. There's a question that's just been asked on the Bloomberg by a terminal subscriber that I'd like to share with you. Could you ask Bob about what's different this time versus 2008, in that we know the Fed has QE and they know how to use it. The risk of severe credit risk contagion was real back then, not anymore, question mark. How would you respond to that?
I think what is different this time is everyone's on the lookout for a bubble. Is there complacency or not? We've all been expecting a recession. It hasn't come yet. There are a lot of reasons why it may be pushed off until the back half of this year or maybe into next year. And you do have new tools out there. I think one of the problems is that while we have QE, we're also running QT now. And that's an experiment that we haven't lived through before. I mean, let's face it, we are living through history. And we don't know how it will be written, but we shut down the world for some period over the last 3 years. And now the last of it is just starting to emerge and return to normal. And we've got to adjust for all of that. It just seems very aspirational to me that it's all going to end in a soft landing, we'll reset and move on.
Nothing about this is normal, that's for sure. But Michael at JP Morgan Asset Management is going to be sticking with us, I'm pleased to say. Going through to retail sales in about 20 minutes' time. I think we can squeeze in some sport. Now, Bob, what's going on? Your beloved Liverpool. We can talk about the Eagles in a moment, because that's a better story. But your beloved Liverpool.
I can take it this year. Last year, with the bond bear market, if Liverpool had gone off the rails, that would have been a disaster. Right now, there is a bond bull market. There has been some reset. Money's coming into the market. I can live with some restructuring of Liverpool. I like what Klopp did in the FA Club. He played the younger players. They're hungrier. They were livelier.
I'm the amateur here. Does the World Cup screw this up? I mean, the Tots are playing in a cloud. Liverpool's subpar, to say the least. I mean, I get Arsenal there in the World Cup too. But the World Cup, as you say, in the middle of the season, has that...
It's disrupted. It's disrupted me. I mean, I was just overwhelmed by the amount of football.
Salah?
So I thought it might disrupt the teams with momentum. In the Premier League, that was Arsenal. In Italy, that was Napoli. We've restarted the season.
Italy was in the World Cup?
No, I just thought stopping for a month would disrupt the momentum of the high-flying teams, and that hasn't happened. That was such a poor dig.
I'm learning every day.
Well, no, you're not. You know Italy wasn't
They pulled it off. It was a great World Cup.
Liverpool,
and we're back
Chelsea,
to the full
time to
season.
come back.
Yeah.
Come on. Is that a derby?
Crossed.
Which one?
Liverpool, Chelsea.
No.
Okay, sorry.
Think Everton.
There's another blue team up in Merseyside, Tom, called Everton. Or you would call it Everton, but Everton, Liverpool, that's the derby.
So Fulham is on the way into Heathrow.
Fulham, West London. Chelsea, West London. So that would be a West London derby.
Chelsea, Fulham as well.
Chelsea,
okay,
Fulham.
got it. Thank you.
You see what I have to put up with?
I'm learning.
But Michael's going to stick with us. Veronica Clark coming up from Citi as well. Just around the numbers that report in about 20 minutes' time, we get retail sales and PPI in America. Live from New York, this is Bloomberg.
Today with news from around the world. With the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen and her Chinese counterpart may meet later this year in Beijing and Washington. The Treasury Department hinted at the plans after Yellen and Vice Premier Liu He held a closed-door meeting today in Zurich. U.S. officials said the two exchanged views on macroeconomic and financial developments. Inflation in the UK dipped in December for the second month in a row. According to government figures, consumer prices rose 10.5% from a year earlier. Still, inflation is 5 times higher than the Bank of England's target. The central bank has raised interest rates 9 times in a row since December 2021, and another rate hike is likely next month. In Ukraine, the country's interior minister was killed among those when a helicopter crashed near the capital city of Kyiv. 18 people died, 29 were injured. No word on what caused that crash. Global oil markets face a bigger surplus this quarter than previously expected, even as China reopens. According to the International Energy Agency, world supplies will exceed consumption by about 1 million barrels a day in the first 3 months of the year. Now, the agency doesn't expect to see annual demand growth in China until the second quarter. Microsoft is joining the ranks of tech giants that are scaling back. Bloomberg's learned that the company plans to cut jobs in a number of engineering divisions today. The layoffs are said to be significantly larger than other rounds of job reductions in the past year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Season is here.
Wall Street expecting a bit of an ugly season. People may be overly pessimistic.
We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit. Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Activity is more resilient than expected, and we should avoid recessions this year, probably. And second, inflation will very probably peak in this semester, first on headline and then on core.
All of a sudden, things get very, very constructive for the ECB. Relatively speaking, of course. That was the French central bank governor teeing up the ECB to go another 50, maybe 50 again, and then Who knows? Equity futures right now on the S&P up by 1/3% on the S&P 500. 13 minutes away from retail sales data in America. There is a bid in the bond market. Yields are lower by 8 or 9 basis points on a 10-year, 346.10. If you're waking up this morning and wondering, where is the BOJ news? The news is there is no news. No change from Governor Kuroda and teeing us up potentially, Tom, potentially, I say, for another move maybe in March.
The festivities 9, 10 o'clock last night, Wall Street time, and into the morning is everyone publishing on it. And I get the calendar of a Kuroda retirement here, but I would say far more importantly than the calendar is tomorrow or even tonight. We will see in the Japanese morning CPI nationwide. The Bloomberg survey is a stunning 4%. Unimaginable. And I don't understand the inflation headlines we saw a day ago versus what we're going to see tomorrow. They don't dovetail.
When he hands over the reins after the March meeting in April at the BOJ, is that mission complete or mission incomplete over the last decade for him?
His experiment was successful given the cards were dealt to him that he reflated the system. Ukraine, all the rest of it, China, COVID. He reflated the system. He can say, I did that, but it's for the wrong reasons. And critically, John, he reflated without belief in a persistency. What he wants is persistency, sustainability.
Where's that 10 years gone? That feels like literally a couple of years ago where we'd sit there waiting for dollar yen to go back through 100 to the upside. Shinzo Abe, the late Shinzo Abe running the country.
I sat in the bottom of the Bloomberg building in London, the old one. Okay.
Citygate House.
Jim O'Neill.
Finsbury Square.
And he and I did a panel, and yen was 96, I think, at the time. And he said something brilliant, as Lord O'Neill would do, and he and I moved the yen market in real time.
That was your fault?
No, it was Lord O'Neill, trust me, doing it. But that was a long time ago, and 260% debt. They have 8% of France's debt. 8%. The Japanese own 8% of France's debt.
And the BOJ owns a significant amount of the JGB market now. They've thrown everything at this.
We got the right guest to talk about this as well. Bob Michael with just a massive, massive history.
Waiting for us to shut up.
No, but I think this sets it up nicely. The dysfunction here of the flows in the capital ownership of debt is tangible, and you see it with the Japanese and other percentage of debt. Do you have an inherent fear within your strategy when you see ratios like 260% or where another nation owns 8% of France's debt?
I've got so many thoughts on the Bank of Japan. One, I think they missed an opportunity. I would have done something today and keep the process going of get to something that looks normal while the rest of the world is doing it. We talk about the top end of the band is 0.5%. The target's actually 0, and official rates are actually minus 10 basis points. So there's a lot of room to get things looking somewhat normal while you're printing 4% inflation, and then start the process of transitioning the bond market out of the BOJ hands into public hands, into private investor hands. Get that process going. Now, as I'm saying that, I also get concerned about what that means for assets in the rest of the world, because many of us in the markets for a long time have known that Japan is the mother of the carry trade, that Japan finances carry trades in the U.S. market, in the European market.
That's where Liverpool takes someone from the tots and borrows them. I get that. That's jargon. What is a carry trade?
A carry trade is to use the very low cost of funding in Japan and then take your capital at your cost of funding and then send it to somebody like me to invest in the U.S. bond market, in the corporate bond market at yields of 4 or 5% or higher. So you're enjoying a much higher yield than you would have by staying in the domestic market.
So how do you think these changes that we're seeing in the last month and potentially again in March will change how you do business and ultimately on the behalf of other people who want to invest abroad from Japan?
Well, I think we're already starting to see some signs of repatriation. We're starting to see some clients that have had money in the U.S. market start to take it back and put it back into the Japan bond market. And when you look at U.S. assets, hedge back to yen, you're actually coming out at a yield that's significantly lower than where the JGB market is. So a lot of it is the dynamic of the inverted yield curve in the U.S. So that's pretty punitive. I think the Bank of Japan has to be careful how they unwind all these things so they don't create this frenzy of repatriation. But as I said, I think they can be consistent without creating this sort of frenzy.
There is a part of me that thinks, great, price discovery returns. We can start calling these places markets again. Then I look at the size of the balance sheets and I just think, well, there's a real stock effect here that's going to exist for a long, long time. But there's two ways of looking at it, isn't there? This is the final anchor around the neck of global bond yields, about to be released by Japan, and that should have some real consequences. The other way of looking at it is still, we have these massive balance sheets of the ECB, the Federal Reserve, the BOJ. They're going to be around for a long time. Which one is it?
I think it's both of those. This is the conversation I'm having a lot with our clients because we think we have put in a secular low in bond yields and the end of the secular free-for-all in costless capital. And we're in a trend that will return the cost of funding to something that looks historically more normal, central bank rates, bond market rates to something that looks more normal. But it doesn't happen all at once. You don't go from zero to a Fed
but
funds
over
rate.
that time continuum, what do you do with duration? Are you in 2 months? Are you on 3-month LIBOR?
We'll get to that.
Tell them, Diamond, we got to be in 3-month LIBOR?
Tom, it took 27 years to get the Fed funds rate from 20% to 0%.
So how long is that
and you
time
had
back?
a series of lower lows and lower highs. I think we're seeing the mirror image of that. We're going to have a series of higher highs and higher lows, but every 300 to 500 basis point shift in the cost of funding through central bank rates will have an impact. And then they'll have to come back and take some of that back, and then they'll start up again.
I've got 2 minutes on the clock. I've got to fit this in. You and I have talked about this before. This is a huge thing that I think you're really at the forefront of. You're basically saying that it's going to take several cycles to basically unwind what we've seen over the last several decades. Can you tell me what's changed in the secular story of the last 30 years and why you're projecting that out the next several cycles? What's changed? What's that powerful story that's going to unwind all of this?
Well, there's one certainly in the developed markets. I remember after the financial crisis, we were all sitting there going, oh my God, what do we do with all this housing stock? The baby boomers are rolling over into retirement, and the millennials are too young. The 91 births at the time were what? They were 17 years old. Well, guess what? 13, 14 years has just passed. The 91 births are now 32 years old.
Yeah, still living with me.
But, well, they're hitting their peak of earning, spending, and saving, much like the baby boomers did in the 1980s. And suddenly, all the housing we didn't invest in after the financial crisis, we need it back again. So there are some real capital expenditure plans out there. Sustainable investment, defense, infrastructure, healthcare, education. Those are things that a new emerging population of millennials, the XYZ, whatever you want to call it, they're going to be willing to spend and invest in.
But Michael, this is awesome. From JP
I was
Morgan.
trying to get in
Fantastic.
the football. It was too smart. I couldn't get
And
in
you've
the
got seconds left.
question.
Maybe next.
Okay.
Around retail sales, just to really disrupt the conversation. Veronica Clark on the other side of Citi is going to be joining us. Retail sales data moments away. Reaction from Bob Michael at JP Morgan. Up next.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
News breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
Economic data just moments away in the United States of America. Equity futures on the S&P look a little something like this. On the S&P 500 this morning, positive by 0.2%. PPI data, retail sales, an absolute economic data dump coming up in just a moment's time. Mike McKee's going to break that down for you. Going into it, yields lower by 9 basis points now on a 10-year. Your 10-year yield, 345.37. With economic data, here's Mike McKee.
Well, we're just getting the numbers, and we were expecting a decline in retail sales, and we certainly got one, down 1.1%. The expectation was for a 9/10 fall, and the question is, where do we come in with retail sales control? That number yet to pop up, but here's the PPI numbers, down 0.5% on the headline. The expectation was for down 1/10. Ex-food and energy, it is up just 1/10. That matches expectations, but it's down from 0.4 a month ago. And then the PPI for final demand at 6.2% for the year, and the core for the year 4.6%. Those pretty much the core matches, but the final demand was expected to be 6.8%. So another decline in an inflation indicator that is going to look good for the Fed. Now here's the rest of the retail sales. Ex-auto and gas down 0.7, and the retail sales control group down 0.7. That had been expected to be down 0.3. It was down 0.2 in November. So it looks like a very poor month for retail sales. John, I'll let you do the market reaction to all this while we get details on where the weakness was.
Bit of a mix here. So we've got a downside surprise on retail sales. That is the wrong kind of downside surprise. And we've got the right kind of downside surprise on PPI. I'm sure you can work that out, what that means. Equity futures right now up 0.5% on the S&P 500, just off session highs. Tom, at the front end, we do see a bid in the yield curve. We're down 8 basis points on a 2-year to 4.12%. On the 10-year, down another 12 now on a 10-year yield to 3.43.
Bloomberg Financial Conditions Index pops out to a 0.25. Stunning accommodation away from what Chairman Powell has been hoping for. Mike, we've got to educate the public now, including me, and that is retail sales are inflation adjusted. So with the disinflation out there and the PPI disinflation out there, does that make the gloom of retail sales less gloomy?
Well, they're not inflation adjusted, which is why you have to try to do that calculation.
Do it for us right now. Only you can do it.
What the government does is put the retail sales numbers in the categories that they track into the overall GDP and deflate it from there. So you've got to look at these numbers and think that they're going to be lower than we anticipated. And here's where some of the weakness was. Food down 1.1%. That's an important number for a lot lot of people, food has been coming down. Gasoline goes down 4.6%. Now, gas prices have started to go up again into January, so that's an interesting one to follow going forward. Food and beverage stores flat with food prices down a little bit, retail and food services. Clothing down 0.3. That may have been, Tom, you were asking yesterday about clearance sales, and maybe it's time for you to go shopping because those prices are down a little bit. But here's an interesting one. Non-store retailers down 1.1%. This is it's a broader category, but where you would find your Amazons and Walmarts and online retailers. And then food services and drinking places down 0.9. That's what the one service industry that is in retail sales, and it is sort of the most discretionary spending that we have there. So it does suggest that people pulled back in December all across the board in terms of spending.
Mike McKee, thank you, sir. Just to round things out for you, I'll say it again. Downside surprise on retail sales, the wrong kind, the right kind of downside surprise on PPI. For a moment, equity futures pop. They fade now, up just 0.2%, basically where they were going into the print. Yields still lower, Tom, on a 10-year by 11 basis points, 343.54. And just to give you a feel of things at the front end of the curve, a rally at the front end again on a 2-year. We're down 7 or 8 basis points to about 413 on a 2-year. So yield, just the whole curve, Tom. Just pulling back, pulling lower.
We're advantaged to have Bob Michael with us with J.P. Morgan Asset Management before we move on to economics. And Bob, help us with what the bond dynamics right now signal about the parlor game of 25 beeps or 50 beeps, and even more foolish, something you and I never saw, where the street's gaming out rate cuts out X amount of months. What part of your bond world do you look at to gauge 25 or 50 beeps?
So as Mike was going through the data, in my mind, I was also replaying a lot of the inflation data, which has stopped printing at 0.5, 0.6, 0.7 per month, and is now in the 0.2, 0.3, 0.4. And the words that come to mind are long and variable, cumulative, and lagged. The impact of a year of very aggressive central bank tightening and quantitative tightening are starting to bite the economy, and they're biting hard. So things are slowing down. I think the Fed has good reason to raise rates 25 basis points at the start of February and pause if, for whatever reason, they want to do another 25 in March as insurance. But it feels like we're a meeting or two away for a pause. Then let's wait a quarter or two and see what the impact of all this tightening has done. I think it's a signal to bond investors who have been trying to buy pack-ups. You're not going to get them, certainly not over the next couple months.
Does that apply to credit too, and not just sovereigns? Is that the whole of fixed income?
So where we're seeing money come into the bond market, it's going into aggregate bond funds. Investors are making the decision, get me into bonds, I want a general bond fund, or they're going into a general municipal bond fund. So the investment grade space is going to appreciate. The securitized market, the mortgage market, the investment grade corporate market. The one thing I did get wrong, which you've been very polite about, is the high yield market. It's been rallying like crazy because recession still looks in the distance, although this data says it's not quite as far out as maybe.
Let's finish on that. With that in mind, how much weight would you put on the recent survey data, which is indicating that things are slowing down pretty quickly? How much weight would you put on that?
Well, businesses will respond to that, and they'll start to invest less in their business and start to save. So it becomes self-fulfilling. All of these things, to me, suggest that recession is actually on the horizon.
Bob, this has been great. Equity futures right now up 0.2%. If recession is on the horizon, this credit market is not selling off into it. It's rallying into it over the last couple of weeks. Your 10-year yield this morning down 11 or 12 basis points, Tom, to 343. On a 2-year, down 7 basis points to 413.
These are movements, and again, as you say, it's about the hard data, and I believe this is hard data. I know it gets revised, and I don't have the data up here. Again, there it is. There's the revisions. For example, the control group, I don't have a revision on it yet, but Mike McKee was telling us the revisions were a less of a retail sales than the cautious numbers that we saw in the previous month, and that follows on forward today. Let's get the economic look, and John, I want you to help me out here. Veronica Clark can frame for us the Citigroup conundrum, which, John, I believe, as Mr. Hollenhorst discusses, 50 or 25 basis points. Do you want to bring Ms. Clark in here right now so we can decide and make some news here?
They had a wonderful
Citigroup call.
A wonderful 2022. Let's talk about 23. Veronica, thank you for being with us. You've been leaning towards this idea that we get another 50 basis point move from this Federal Reserve. How challenged do you think that view is now with the incoming information?
Yeah, I mean, it was already a close call, I think, even going back a week ago when we got CPI. And certainly what we've heard from Fed members since. I do still think, though, that the market could be underappreciating, the chance that the Fed would opt to go 50. I think the market is misinterpreting, the Fed's commitment to getting rates above 5%, certainly.
Veronica, we're all slaves to the data. Every Fed and every textbook and every history book is data dependent. You guys got out front of this, and the data has backed up the Citigroup call. What is the data that matters to you, less to February 1 and much more to look on to what we see May 3rd or June 14?
Yeah, I mean, I think the most important data is still inflation data, and I would bump along with that, wage data. Maybe we've seen some signs of wage growth slowing, but you still have such a tight labor market that I wouldn't necessarily expect wages slowing back to something consistent with 2% inflation. And the most important inflation data, I think, should be the Fed's preferred core PCE measure. And some of the details of PPI that we got this morning will matter for that. We are still expecting, stronger core PCE than what the Fed even has, certainly than what the market's expecting.
Are you going to reaffirm right now 50 basis points? Is that what I'm hearing?
Yeah, I think that chance is still underappreciated. We do have some important Fed speakers still to hear from, and the chance is lower, certainly. But we also wouldn't necessarily adjust how high we think rates will end up going, even if it's not a 50 in February. Would just expect that the Fed's hiking for longer.
Did she make news there?
No, stuck to the script.
I'm trying.
We're not going to cause any trouble over at Citi,
I'm
are we?
trying.
Veronica, that was great. Thank you. Veronica Clark there of Citi Global Markets, alongside Andrew Hollenhorst making the calls there over at Citi on the Federal Reserve. Final word with Bob. Bob, what do you make of that? We go another 50? Terminal rate's going to be higher than people think it is?
I don't think there's anything in the data that we've seen over the last month to get the Fed to go 50. And I think they've opened the door to continuing to dial down the pace and rate of hikes. So I think 25 is pretty much in the books for
This
them.
is really important, and this goes back to Bowder and the work at Citigroup, the fabulous work at Citigroup versus what we see from Kasman and Feroli. Michael Feroli's call on U.S. potential GDP X number of years ago is how you get to 25 beeps. Is there's just a dampening there that I hear out of J.P. Morgan that I don't hear from other shops.
You're going to cause trouble between the investment bank and the asset management division over at JP Morgan. Is that the goal this morning?
I know I'm crossing the Chinese wall or it's the Japanese wall. I don't know.
I think
Makino's
is a brilliant researcher and economist. He is my go-to read.
There we go. That's nice.
His potential GDP call, which was sub 2% of the time, is how you get to this, to your point of the great moderation ending.
Yeah. Exactly.
Did I do okay there?
You did great.
Which wall did I climb over,
You tried
Mike?
to cause trouble at Citi.
I am.
You think Citi's going to come on and change the call before they've published?
J.P. Morgan, who's next?
And then get Bob to
Why
fall
do you
out
think
with the
we're not in
investment bank.
Davos? I thought I'd, cause trouble
We had Tom
there.
locked down
Which
behind
wall?
the Chinese wall.
Which wall did I just climb over, Mike?
In the next
You're
hour.
in lockdown again.
In the next hour, Jay Poloski of TPW Advisory. You've been waiting to catch up with Jay. He's going to join us in the next 60 minutes, yeah? Priya Misra of
I
TV.
have him or you have him?
I've got him.
Oh,
Aaron
you've
Brown
got
of
him.
PIMCO, and I'm going to drag Bob Michael with me as well, just to round things out for the next hour on Bloomberg TV. What a morning already. If you're just tuning in, we're going to talk
Can you
football.
explain to
We're
me
going to talk
how
retail
Liverpool
sales,
plays in
inflation,
the Premier
job
League, and
cuts
then
at
8 days
Microsoft.
later they play the FA Cup? Do they play differently in the FA Cup than Premier League?
If you've got a deep squad and they've got tons of depth, less depth than, say, Manchester City, but they've got enough, then you play different players. You play the younger players, to Bob's point.
Yeah.
You play the hungrier, younger
Who's
players.
the guy that did defense that's so good from Belgium?
Virgil van Dijk.
Virgil van Dijk.
You try and rest players like that. Although he's not had a great season. He's not had a great season at all.
World Cup disease.
You reckon it's that? World Cup disease?
Injuries.
World Cup disease. Is that what you're going to get?
Yeah, they were in the World Cup and they're all exhausted. Mike and I saw this in hockey.
I love the way Tom
years ago.
sounds like he knows
My
what he's
goodness,
talking
Mike.
about.
My goodness, that's the whole show, isn't it?
I don't give it away.
I'm working overtime. I've got to go. From New York, this is Bloomberg. Thank you, Bob. Appreciate it, sir.
Thank you, Bob. Did you go?
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy is calling on Democrats to engage in talks over raising the federal debt ceiling. Republicans now in control of the House have been demanding deep spending cuts as the price for increasing the limit. But President Biden wants it raised without conditions. And that raises concerns of U.S. payments default. In San Francisco, opening arguments are set for today in Elon Musk's trial over claims he defrauded Tesla investors. The case has to do with Musk's tweets in 2018 about his plan to take the electric car maker private. A 9-person jury was selected on Tuesday. Mortgage rates in the U.S. fell to a 4-month low last week. According to the Mortgage Bankers Association, the rate on a 30-year fixed loan fell 19 basis points to a little more than 6.2%. And that helped applications soar by almost 28%, although the data can be a little volatile around the holidays. The world's biggest oil company is confident demand will pick up strongly this year. Saudi Aramco CEO Amin Nasser spoke to Bloomberg at the World Economic Forum in Davos. Nasser says he sees promising signs in demand both from China and the aviation market. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, there's 100 companies, Breakthrough Energy's funded.
By mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come out. So that's the package that you're talking about mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, now 4% of new cars are electric, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
I think in the United States, we're obviously fighting higher interest rates, but we're doing it from the perspective of an economy that's in quite good shape. During the pandemic, people stayed at home. That $2.5 trillion of extra money was in the banking system, and they've been spending that money. And that's been keeping the economy performing better than people expected.
Steven Schwarzman at the meetings of the World Economic Forum in Davos. He is with Blackstone. He is their chief executive officer, and far more than anyone I know, a student of linking in economics into finance. And of course, with his Blackstone group, front and center across America has been their commitment to real estate, a huge debate about the future of American real estate wrapped around private equity, private investment, and directly with what Blackstone is doing. After the retail sales, we've got futures up 13, Dow futures with a modest lift. I'm watching the VIX very carefully. It's a quiescent 19.08. That's a substantial change from what we saw 10 days ago, and to see an 18 print would signal the bid to the market. In the yields, a 10-year yield comes in a huge 11 basis points off the shock of tepid retail sales and revisions Two-year yield comes in 7 basis points as well. And we're watching Brent crude 87.23 a barrel. It was most important today to have one of our guests say, watch the shadow banking system, something Ambrose Evans-Pritchard talked to Ken Rogoff about. She has spoken to Professor Rogoff at Davos about shadow banking, about overinvestment in private equity, and there's some real debate about this. Lisa Abramowitz at the meetings in Davos drove this conversation forward this morning. On private equity, away from the markets, the shadows, Lisa, not the shadows descending across Davos now as the sun, I think the sun falls, I think it falls down to France or Italy. I can't remember which, but the answer is the shadows of shadow banking are front and center.
Yeah, the shadows, if you look at some places, they're not so shadowy, although I was just on a panel with the head of the French Central Bank, and he said that he is very concerned about the shadow banking, the non-banking financial markets. So basically to that point. However, I did speak with the former co-chair of Bain Capital, Steve Pagliuca. He just actually retired yesterday, although he hates the R word, stepping down, but he's still going to be an advisor. And I asked him whether he thinks that we've already seen peak private equity, whether we're in for some sort of significant downturn. Take a listen to what he had to say.
If you look at private equity returns, most firms are shooting for 18-20%. The private equity model works. It puts capital to work with experts that really help drive these companies, and certainly Bain Capital. I think we're only still in the early innings, and it has another 20 to 50 years to run because it's a great business model.
And you can see it being 18 to 20% in that period of time as well.
Absolutely. It's consistently done that for 40 years now.
What about in China? What about some of these other areas that a lot of people are pushing into and seeing a lot of value? Is Bain as well?
Well, we've had a fantastic Asian presence for a long time now. We were one of the first people into Japan, for example. Japan's a fantastic market because they are now embracing capitalism. I met with the Prime Minister about a month ago. He's pushing that. They've got to rejuvenate the economy. They believe they got to have more free markets and more capitalism. And we've been fortunate because the Japanese really respect a company that's trying to build value and sticks with Japan. So we never went in and out. We went to Asia. We stayed there. We built a large presence. They love the value-added approach.
You do own the Boston Celtics. You are interested in the Chelsea football team. Didn't win that bid. Are you looking to push further into the football arena?
Our group is looking at many teams. The prices have gone up very high, and we want to buy a great club, but we want to stay disciplined so we can invest in the club over the future. And so my fear is some of these prices are now getting so high that there might be disinvestment, and I want to have a great club, and I want the club to be able to win, and you got to be competitive. So you have to budget putting money in to make it competitive.
That was Steve Pagliuca of Bain Capital. And Tom, I'm sure that you're interested in the football discussion, but honestly, to answer your question, there is a lot of optimism, not so shadowy necessarily, among a lot of private equity executives who are here.
You know, what's really interesting, and this goes to your panel, Lisa, you had Michael Maybach on it, the president, the chief executive officer of MasterCard International. They have the thermostat, they have the thermometer of every, folks, the name of the panel, by the way, was Bramo Does Davos. And the answer is, there's a thermometer to it. There's a pulse to it. What's the Davos thermometer this year?
Well, I would say that soft and shallow. Shallow and short would be basically the concept, the consensus right now around what people are thinking about the recession or the lack thereof. My first question on the panel was, are we going to get into a recession? And the head of the French Central Bank said no, even though they're going to raise rates further and go above the neutral rate. And other people saying the same thing. Michael Maybach of MasterCard saying that the actual empirical data doesn't seem to show any sort of downturn from spending. On the flip side, there's this real tension here between this belief that you can raise rates substantially more and continue with the dynamism. And I know that the retail sales that we just got suggests that there is a bit of softening that hasn't been reflected in at least the tone that we're hearing from certainly central bankers here at this particular event.
Happy Valley is removed from reality. Mrs. Zelensky appeared to bring back reality. How is the leadership of Ukraine and Mrs. Zelensky greeted today?
A lot of people are trying to figure out how long it's going to take. I mean, very much there is a real question mark here of how long this is going to drag on and what the implications will be. That is definitely on the forefront. At the same time, very much the focus is on China and the reopening and the question mark around what that's going to do to inflation, what that's going to do to growth at a time of increasing tension. And so I think that underpinning every conversation is we'll see as possibly an escalation in the war that Russia has waged on Ukraine. That's less the conversation right now than China, the reopening, and what that means for inflation.
Yeah, I would say the headlines, Lisa, that we saw back in the West was very much the China reopening, the comments of the Chinese leadership meeting with Secretary Yellen here in the coming hours and days. What's amazing to me is how it endures across the Pacific Rim. I mean, you have the Filipino president, Mr. Marcos, attending as well. You've got others from the Pacific Rim. What is the feeling of Asia opening up? I think it's underplayed.
I would agree, and I think there's an incredible amount of optimism. And frankly, underplayed is the reliance of the West, in particular Germany, on China to reopen in order to get that economy going. And a lot of the optimism that we're hearing about the European economy, how much of that is hinged on China reopening? So, you know, on one hand, we're talking about deglobalization,
right.
We're talking about unhinging the West from the East, and in reality, it's not that at all when it comes to conversations or what people are depending on. And so that, I think, is a big theme.
And full disclosure, folks, I got an email in, and no, that was not Lisa's Gulfstream. A photograph at Zurich of all the fancy people's planes lined up at ZRH. Lisa, with that said, what does ESG look like at this year's Davos?
A lot of people are saying that they're going to recommit to it and that they're going to continue to finance it. I mean, it still is a big piece of it. I guess the question that I have is, what's the role of investing in fossil fuel companies at a time when you're trying to prioritize ESG? And I was speaking with the Norwegian Sovereign Wealth Fund manager, the CEO of the biggest sovereign wealth fund in the world today about that. And they have this mandate to diversify away from fossil fuels, but they're still investing in diversified oil companies, energy companies, and trying to affect change from the board level. So still there is this feeling that there is a place for an investment in the energy, in the oil complex, while also pushing for ESG types of mandates.
Did you get briefed on that by Mike Wirth of Chevron? Did he step in there to talk about future investment of hydrocarbons?
Yeah, I mean, they're big on this, right? Because this is ultimately their future. Again, I hear your skepticism. There is this feeling of how quick is it going to be, and what do you invest in the meantime at a time when you still need the fossil fuels to get going.
Lisa Ramrins, thank you so much. At the meetings of the World Economic Forum in Davos, her coverage will continue along with our team in the coming days as well. Our coverage is about retail sales that came in soft, with a soft revision as well. PPI a little bit quiescent, and I guess you're going to see in the coming 6 hours a nudge here towards a disinflation, maybe a nudge towards a adjustment by the Fed from 50 basis points down to 25. Thank you to Andrew Hollenhorst and Veronica Clark over at Citigroup. They, I'm sure, will have statements out overnight on their call of 50 basis points. Really appreciate her attendance today as well. I do want to point out, and this is important, that through the Bloomberg Day on radio and television, I need to guide you to this evening. After you've forgotten about economics, finance, and investment, they will remember it in Japan. Without question for me, the inflation report of the day will be what we see out of Japan. Will we see headline inflation on survey of 4%. Please stay with us with futures up 14. The VIX right on the cusp of an 18 print. I'm going to call it better than good markets. Good morning. This is Bloomberg Surveillance.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. This is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
We
we've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Yields down, stocks up. Live from New York City this morning. Good morning, good morning. Your equity market firmer by about 1/3 of 1% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, retail sales disappoint as inflation softens, Microsoft planning another round of job cuts, and United Airlines delivers a beat and a raise. We begin with a big issue, recession or recovery.
We have, amongst investors, a very, very different view.
We're going to have a recession or
the economic recovery.
On one hand, if we're going to recession, bond yields at the longer end of the curve are still too high.
Perhaps there's a little bit too much complacency on what central banks are going to do.
If we're not going to recession, then it's kind of the opposite.
Huge rallies to start the year.
A lot of optimism on demand.
Certainly our core call is that we're rallying into recovery.
Every piece of data comes in, it's gonna tell us part of the story.
We think that you're going to get a recession.
It really does depend where you look.
We hope that the Fed will engineer a soft landing here in the U.S.
This has the signs of being a soft landing.
But the jury is still out.
Mike McKee, that debate is wide open this morning.
It is, and if retail sales is a canary in a coal mine, that canary just choked and fell off its perch because retail sales were pretty bad during the month of December. Surprisingly bad, down 1.1% more than forecast. The control group, which is what goes into GDP, even worse, down 0.7%. You look at PPI, it comes in down. Inflation really seems to be falling, and the core for PPI also sequentially lower. So the Fed likes to see the second two numbers, the first two, not what they've been expecting. Here's why we saw a big drop in retail sales. Car sales, we knew were down 1.2%, not as bad as November, but still down. And gasoline prices really fell. Now, the interesting thing here is that has a big effect on retail sales, but gasoline prices have started to go up again. Remember, retail sales denominated in dollar volume. Grocery prices falling a little bit, so grocery sales flat. Look at what happened to department stores. Didn't anybody go out and spend money for the holidays on gifts? Non-store retailers also suffering, also a bit of a surprise. Amazon maybe not doing as well as people thought. Eating and drinking places, the ultimate discretionary, down 9/10. People stopped going out, at least in the month of December, it appears. In terms of the PPI, here's something interesting. Goods prices deflation now, down 1.6% during the month. The Fed has been talking about goods prices falling and inflation falling away there. That's what's happening. And services prices actually declined on a sequential basis, so that is good. And the core, which is ex-food, energy, and trade services, which is basically the margins for retailers, up only 0.1%. So from the PPI standpoint, we're seeing a real drop in inflation, but at the same time, is the economy weakening? That's going to be the debate.
Mike McKee, Fed speak a little bit later. Bostic in just a moment. A little bit later this afternoon, Harker, then Logan. Are we leaning towards 25 in early Feb?
25 seems to be kind of locked in at this point. There doesn't seem to be any reason why the Fed would need to do 50 unless you're convinced you have to go there and it's better to get it over with at first. But I think this retail sales number is a bit of a warning that the Fed needs to be careful as it gets closer to 5%. So they'll probably do 25, not ruling out another 25 at the next meeting.
Mike McKee, stay close. We'll catch up in the next 10 minutes or so. Back with us, TD's Priya Misra, TPW's Jay Pawlowski. It has been a while, Jay, so welcome back to the show. Priya, I want to catch up with you straight away. Retail sales data, PPI, about 33 minutes ago. Your response to it?
So I think retail sales suggests that the consumer is slowing. But I will caution, I mean, it's goods consumption largely. We know that the consumer is moving away from goods to services. I mean, is the economy slowing? Absolutely. Is the consumer slowing? Yes. I think that savings, accumulated savings that we've been highlighting, that's been coming off. But I would say this is the intended consequence of Fed tightening. I mean, they want demand destruction. They're seeing that demand destruction. I think the recession talk, I do think, in our base case, a recession happens in the second half of the year. But I don't think the Fed stops. I mean, they may go 25 next meeting. We're actually calling for 50. They can go 25. I think their focus has to be that terminal rate, that above 5% terminal rate. So the market that I think is looking at the weakening consumer, the fact that inflation seems to have peaked and saying maybe one more 25, maximum two more 25. I think the market's too optimistic in terms of how quickly the Fed might stop hiking and start cutting rates. I think they're really far from cutting rates. The idea that the stock market can rally on weak numbers, that I really struggle with. I think the bond market is starting to get nervous about this recession later in the year, and that's why you're seeing longer end interest rates really lead the decline in
Well, let's be clear.
Rates.
This market's rallying hard abroad as well. EM equities, Euro Stocks 50. The Euro Stocks 50 before today. On the year so far, year to date, the Euro Stocks 50 is up more than 10%. EM equities up about 8%. The much followed Golden Dragon China Index up by 16% year to date. You can take your pick. Jay Pawlowski, this is your world. Now you tell me, recession or recovery? What should we be pricing here?
I'll tell you, John, we own all three, and we're happy to do so. We have for quite some time, and we'll continue to do so. No recession. Inflation coming down. Fed raises 25 in February, then goes on an extended pause. We agree with Trita that the Fed is not likely to cut rates because there's not going to be a recession. And the real key here, John, are two things. First, the headwinds of 2022, inflation spike, rate spike, Fed action, are turning into the tailwinds of 23. Inflation rolling over, rates coming down, Fed going on hold, volatility declines, the dollar weakens, the rest of the world starts to pick up. Europe led the way with the halving of natural gas prices last fall. I wrote a piece that I titled "Things I Don't Understand," And one of them was that European natural gas prices had halved, but European assets didn't react at all. We've obviously seen, as you pointed out, that's changed. And more recently, and I think more importantly for the global economy and global markets, is the about face that China has done on zero COVID. This is the single biggest, most important positive thing for the global economy one could ask for. It puts paid to the idea of a global recession. And I think it suggests that emerging markets are the place to be. We were very keen on Europe last year. We're now very keen on emerging markets, and in particular, very keen on Asia as a geographical region.
And for a lot of people who had recession baked in for this year, they're now pushing that back. They're pushing back on it big time in some places. Mike Gapon of B of A in the last 24 hours pushing back as well. He said the following: our outlook still includes a mild recession, but we now expect it to start later and come with lower peak unemployment too. The cause of the delayed downturn is consumer spending, which has been stronger than anticipated. Now, there might be a question mark on that with this retail sales data this morning. Priya, would you push back the recession call as well? When you and I last spoke, you were talking 550 on Fed funds, curve inversion all year, and recession in the second half of 23. Can you talk to me about the third point? Is it still recession in the second half of 23?
It's still recession. You know, I look at real rates. So if you look at real rates across the curve, they're very high. I mean, we look at the 10-year that's gone from, you know, above 4% to now below 350. It's all been a break-even led move. Those real rates are still very tight. To me, that tightens financial conditions. I know, you know, equities and others have outperformed, but we've had significant tightening in financial conditions from a real rate standpoint. That's still putting pressure on the consumer, and that accumulated savings buffer, you know, the consumer still has savings, but it's coming down really fast. You know, wages are high, but they're not keeping up with inflation. By the middle of the year, we think that savings buffer goes away. The tighter financial conditions, no savings. The moment the job market starts to turn, I think consumer spending really nosedives. So, you know, is it third quarter, fourth quarter? You know, that's a harder one to call. But second half of the year, we do think that recession comes in, and then it's going to get really tricky for the Fed. Do they respond? You know, they're looking for the unemployment rate at 4.6. We actually don't think we'll be much higher than 4.6. And the Fed, I think, then says, look, inflation's still too high. The unemployment rate is not that high. We're going to stay put. And I think that's going to be really tough for the market, especially risk assets that are looking for that Fed put. The moment we hit a recession, I think that Fed put is much further out. We're looking for all these rate cuts really in 24 rather than 23. So now we're still looking for that slowdown because, you know, I think we can look at the equity market, but look at the housing market. That's slowing pretty sharply. Real rates. I think all the headwinds for the consumer are still very much there.
This whole curve sinking this morning. We're down 10 basis points on a 2-year to 4.1%. Just broke that level. Your 10-year yield down about 15 basis points to 340. What Priya's talking about here, one of the reasons why Marko Kolanovic over at JP Morgan is still cautious on risk. He says this: we remain cautious on risk assets. We're reluctant to chase the past week's rally as recession and over-tightening risks remain high. A lot of good news is already in the price in terms of inflation moderation or the potential for a soft landing. So this is one for you, Jay. So, Jay, you're in a different position because you were already in the trade and this trade is performing. So the decision you've got to make is whether you stick with it or get out. For people like Marko who haven't been riding this wave, although he does like EM and does like China too, they've got a different decision to make. Do they chase it? Do they get in? What do you say to those people that are on the sidelines here, Jay, that have missed out on this rally in the first couple of weeks of 23?
Well, there are many of those people, right, John? And that's where the majority of people are. And the narrative has shifted so quickly. And, you know, we've been all about speed for the last couple of years here at TPW Advisory. COVID speed, climate speed, conflict speed, now narrative speed. The narrative has shifted. Most people are behind the curve. Look, near term, very near term, things are overbought. If you look at China, if you look at EM, if you look at European banks, they're overbought. So you wait for any kind of pullback, and there's always a pullback. Who knows why? It will happen. And then you need to get in with both feet, because I think this is, things have changed. We're now in a different direction. I don't disagree with the outlook that was just given on U.S. equities, right? We're looking for a flattish type year. And I'd remind people that a flat type S&P with a weak dollar is the most positive environment possible for non-U.S. equity. And we believe we're at the beginning of a multi-year bull run for non-U.S. equity versus the U.S. And I just would lay out two reasons why. First, on China. It's really important to understand that it's not just a shift off of zero COVID. China has shifted economic policy, no more bashing tech companies, no more 3 red lines for property developers, and they're pulling back on their wolf warrior diplomacy, reassigning the wolf warriors to some, godforsaken place to do nothing. So this is a sea change in China. China is going for growth. They have the ability to do so. And the second issue is that weak dollar. The weak dollar really drives the non-U.S. Equity markets, and we think there's opportunity across the board in Japan, in China, in Brazil, debt and equity. We have about 20%, John, of our global multi-asset model portfolio in emerging market debt and equity.
Wow.
It's the most books I've been on EM in years and years.
Well, it's backed up by the price action now, Jay, in a big way in the last couple of weeks. Equities this morning, just a little bit firmer. Priya, you and I need to talk about this rally of the bond market. The 10-year's down to 340. Brief break of that. Your 2-year at 410. Brief break of that as well. We're down 10 basis points at the front end of the curve. We're down about 14 or 15 on a 10-year. Priya, can you tell me where you are now on treasuries? And can you tell me what you think of this move this morning?
Sure. So I think the move today was partly retail sales, partly also BOJ. I mean, last night, the BOJ did not move yield curve control. I actually think it's inevitable. They're going to have to give up on yield curve control. It didn't happen last night. It's likely to happen by April. They're going to get a new BOJ governor as well. There's a global reflation trade. Japan has also seen, higher inflation, higher wages in our view. They're going to have to give up on it. And so I think term premium or, this demand for treasuries that's come from the Japanese investor base, that's going to be less. So I think that's putting some upward pressure on rates. But then we've got this issue in the US where the market's pricing in a recession. I think bonds are a very good diversifier here. If the economy is going to go into a recession, longer term treasuries, I mean, our forecast is 285 for the 10-year by the end of the year. Has it happened really fast? Yes, I think the market's taken the inflation decline, the fact that the consumer is slowing too hard and is pricing that in. I don't think it's going to be a straight line down to 285. I actually think in the near term, we can rise a bit in yield as the Fed says, hold on, we are trying to slow things down. And, this is intended. And we're not going to stop our hiking because inflation core services ex shelter is still high. It's still accelerating, as we saw last week in the CPI report. So I think not a straight line down, but I do think the longer term trend for long-term treasuries is lower, and particularly real rates. Look at those 10-year real rates, well north of 1%. The economy can't handle north of 1%, long-term real rates. So I think the long-term trade is lower 10-year rates in the 2 handle by the end of the year. Near term, I do think the market might be a little too excited that the Fed is done. I think we're going to hear from a lot of Fed officials, and they're going to say, no, we can hike at a slower pace, but we still have to keep going. We have to go above 5%. That's not priced in. So I see volatility. It's a less liquid market. I see interest rates rising in the near term, but I think the trend is still towards, people buying bonds here for that recession, because at least the inflation fear seems to be a lot less this year.
Well, they're certainly piling into bonds right now. Priya, Jay, you're going to be sticking with us. We're going to talk about the BOJ in just a moment. Just getting news from Microsoft. Microsoft to slash 10,000 jobs through the end of 3Q 2023. There was some indication of that from reporting yesterday from Sky News in the UK that it could be 11,000 jobs. That number is 10,000. Microsoft to slash 10,000 jobs through the end of Q3 2023. We're going to pick up on that story in just a moment, and we're going to talk about the BOJ pushing back on speculation.
The Bank of Japan likes to surprise investors. However, they are on an unsustainable path, and what they did during the holidays has opened Pandora's box.
The latest on the Bank of Japan and the latest on that headline from Microsoft to slash 10,000 jobs through the end of 3Q 23. All of that coming up next.
more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Some breaking news just moments ago on Microsoft. Kaylee Light has more. Hey, Kaylee.
Yep, 10,000 jobs being cut by Microsoft, or roughly 5% of the company's workforce. And the company will take a rather large charge in relation to this of about $1.2 billion in the second quarter. That's about a 12-cent negative impact to earnings per share, according to Microsoft. Remember, Bloomberg reported yesterday that Microsoft was planning to cut jobs in engineering divisions today. Now we have a better understanding, perhaps, of the magnitude of those cuts. And just on that magnitude, John, remember, Microsoft already has been trimming back its workforce. It cut about 1% of its 200,000 person workforce in October and also in July. Obviously, these cuts today with about 5% of the workforce are much larger. The company also taking action on the real estate footprint. Microsoft is consolidating its leases to create higher density offices. And we heard from the CEO, Satya Nadella, at the World Economic Forum in Davos today, talking frankly about softening demand, how they are going to have to do more with less. It seems to be about efficiency, John, and for Microsoft, that means 10,000 job cuts are planned for the company.
Hey, Kaylee, thank you. We'll pick up on that story around the opening bounce. Some breaking economic data as well just moments ago. Mike McKee has that. Hey, Mike.
John, more bad news on the economic growth front, and that is the industrial production numbers for the month of December, just out from the Fed, down on the month by 0.7%. That's much worse than had been anticipated. 0.1% decline was what had been anticipated, and the manufacturing part of that is down 1.3%. That is much higher than the 0.2% that had been forecast. Capacity utilization falls to 78.8%. Notable because that certainly takes off more inflationary pressure. So at this point, it looks like demand destruction, as Priya was talking about a few minutes ago, is still underway.
Hey, Mike, thank you. Two stories here, the softer data in America and the layoffs from Microsoft. So let's go to the former, then we'll get to the latter. Priya, first to you, just on that softer IP data from moments ago. Your response?
Sure. I think manufacturing is in a recession. I mean, we're seeing this in ISM, all the regional PMIs data, but the US is still a service economy, and service consumption is still okay. It is slowing, but I think the Fed wants it to slow. I mean, I think it's going to slow a lot more as the consumer, deals with a lower accumulated savings. But the manufacturing sector clearly in a slowdown. We're watching services spending. We're watching service employment. The US is 75% services. So I think that's what we should all be focused on, and it's clearly slowing.
Manufacturing in recession. Is tech in recession? This was Satya Nadella of Microsoft a little bit earlier today in Davos, Switzerland. During the pandemic, there was rapid acceleration. I think we're going to go through a phase today where there is some amount of normalization in demand. We will have to do more with less. We will have to show our own productivity gains with our own technology. Those comments just ahead of that announcement that 10,000 jobs will go. That stock is up by 0.8%. Guggenheim actually downgraded the stock just yesterday. That was the first bearish call we've seen on this name in 3 years. And here was the quote from the analyst. While most investors see Microsoft as a large, stable business that can weather any storm, it does have vulnerabilities, some of which could be exacerbated by this macro slowdown. The analyst went on to say, we're in a prolonged macro slowdown and no one is immune. Jay, can I finish with you just on that? The cyclical challenge these big tech names are going to face in America and beyond.
Yeah, John, we've not been positive on big tech for, I don't know, a year and a half. High rates are kryptonite for growth stocks. So that's not an area where we've been focused. We're in value, we're in small caps, we're in cyclicals, we like financials, we like industrials globally. And I think Japan is actually showing that the world is moving to a higher nominal growth plane. You may recall that high nominal growth thesis because we talked about it a bunch over the course of 2022. I think Japan is just confirming that. And we look for a global capex boom over the next couple of years to deal with the 3 C's of COVID, climate, and conflict, with both public and private spending to support that. So we're pretty optimistic. And with the U.S. data being negative, that just feeds our case, right? We're overweight non-U.S. equity. You know, U.S. news that's not great is okay for us because it reaffirms the weak dollar. And the weak dollar is really the thing that we're focused on here. A weak dollar drives money and flows into non-U.S. assets, and that's what we're seeing. And John, as you know, it's been about a 12-year run since the bottom in 2009 for U.S. assets, led by big tech. That whole trade is unwinding. It's going to take years for that to happen. We're in the very first inning of what as I said earlier, a multi-year period of non-U.S. equity outperformance led by both developed markets like Europe and Japan. We're double weighted in Japan equity, and emerging markets led by places like China, Brazil, etc.
Well, Jay, it took a while, but the world is coming towards you, at least for the first couple of weeks of 23. I promised you a victory lap. Jay Pawlowski there. Priya, wonderful to hear from you as always. Priya Misra there. Coming up later, PIMCO's Erin Brown.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
From New York, here are your morning calls. Redburn downgrading Exxon, giving the stock its only sell rating, looking for the good times to come to an end. Citi downgrading Morgan Stanley to neutral, seeing limited upside after rallying on results. And finally, Morgan Stanley downgrading IBM, seeing a challenging time amid increasing competition. Coming up next, PIMCO's Erin Brown, expecting China's reopening to fuel a rally in US large caps.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading out into space will really change our society over the next 50 to 200 years. It'll be completely different.
The moment news breaks, no one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is Bloomberg.
Live from New York City, good morning to you. Busy morning so far. Equity futures just about positive by 1/3 of 1% on the S&P. The story so far this morning, the wrong kind of downside surprise on retail sales, the right kind of downside surprise on PPI, and then IP, industrial production, comes in a little bit softer too. Equities, with that, up higher this morning on the S&P and on the Nasdaq. On the Nasdaq by 0.6 of 1%. Elsewhere in the bond market, switch to the board, get to the bond market. We look a little something like this. Your 10-year yield lower by 16 basis points. Your 10-year 338.98 on a 10-year right now. A break of 340, a big rally in the bond market. This whole yield curve just sinking lower. Dollar weaker, euro dollar 108.80. Euro dollar positive 8 or 9/10 of 1%. And crude up by a little more than 2%. $81.97, let's call it 82. That rally continues on crude. About 25 seconds into the session, a broader equity market looks like this. On the S&P, up 1/3 of 1%. On the Nasdaq, up 0.7 of 1%. One stock to watch at the open, United Airlines. Recession, what recession? It's a beat and a raise of guidance as well. The CEO, Scott Kirby, saying this: we managed through one of the worst weather events in my career. We're now poised to accelerate in 23. Kaylee has more. Hey, Kaylee.
Hey, John. Well, the stock's certainly accelerating this morning. It's up about 3, nearly 4% at the opening bell, and taking its airline peers along for the ride as well. You have Delta and American each higher by more than 2%, and even Southwest, which is the one that really struggled with that winter weather, Scott Kirby mentioned, is higher by about 1.4%. This print for United came in way better than expected, not just in terms of the fourth quarter, but the guidance handily topped estimates. For the fiscal first quarter, the company is expecting earnings of between 50 cents and $1 a share. That is more than double the analyst estimate of 22 cents a share at the low end, more than quadruple it at the high end, and the full year earnings guidance of between $10 and $12 a share also blew past expectations. So really, really strong guidance, and it really all comes down to pricing power because of the remaining mismatch between supply and capacity and demand. That is why United and other airlines have been charging all of us high fares. That's a bummer for us, but it helps them when it comes to the bottom line. Just for United, the average fare per mile climbed 20.8% from 2019 levels in the quarter just reported. So that yield strength is really what is driving things. And in turn, it has helped drive the stock higher. United this morning is trading at its highest level in roughly a year and a half since mid-2021. But just keep in mind, we still remain well below the levels at which this stock was trading pre-pandemic. It was north of $80 a share back at the end of 2019. This morning, it's trading around $52.
Trying to recover now, Katie, thank you. Year to date, though, what a move. Up 38% year to date on that single name. And I say year to date, what are we, 10, 11, 12 trading days into the year so far? Another company on a victory lap is Moderna, the drug maker's RSV vaccine, proving highly effective in its final stage trial. The CEO said the following: what we have is a very good vaccine with very strong efficacy to mild disease. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, traders are definitely cheering those trial results as well. You have Moderna shares up about 7% from the bell. And of course, this sets up a three-way competition for an RSV vaccine with other drug makers such as GSK and Pfizer. Pre-market, not as much action from them as for Moderna. But remember, both of those companies applied for U.S. clearance for their own vaccines last year. So let's dig into those results. We're looking at vaccine efficacy for less severe RSV cases. You can see that Moderna shot blocked about 84% of cases in that phase 3 trial. That's slightly ahead of GSK and well ahead of Pfizer. And JP Morgan came out and said that overall, this Moderna vaccine, it compares well to Pfizer and is competitive with GSK. And of course, this is crucial to Moderna's bottom line. Obviously, we know that COVID was a huge boom for this drug maker. Sales went from $60 million in 2019 to an estimated $19 billion in 2022. But you can see expected to drop off to about $8 billion this year, John. So that pipeline is key.
Katie, thank you. The latest on Moderna, the stock up by more than 7%. Let's turn to tech. The layoffs continue. Microsoft planning to cut 10,000 jobs through 3Q, and Amazon starting to cut 18,000. Microsoft CEO Satya Nadella speaking this morning, saying during the pandemic there was rapid acceleration. I think we're going to go through a phase today where there is some amount of normalization in demand. We will have to do more with less. Ed Ludlow on the West Coast with more. Morning, Ed.
Yeah, good morning, John. Microsoft up 0.3%, pairing some of its early gains in the session. 10,000 job cuts for Microsoft would amount to around 5% of the workforce. That's probably more than we were envisaging. Remember, Bloomberg only reported 24 hours ago that these cuts would focus in engineering. In terms of how this impacts Microsoft, a negative impact to EPS of 12 cents in the fiscal second quarter, which they should report at the end of this month. Another way of putting it, it's a $1.2 billion charge. Layoffs are never pleasant, but investors seem to be cheering this news at least, although it's sort of trading in line with market. Amazon, much more significant gains, up 1.8%. We knew these layoffs from Amazon were coming. They're already announced 18,000 jobs, which is 1% of Amazon's overall workforce, including contractors, but a higher proportion of corporate workers, around 6%. So far, those layoffs at Amazon have focused on the devices business. Our understanding is that when they start the process of cutting those jobs on Wednesday, from Wednesday onwards, that it actually will expand to the retail and other marketing divisions of the company as well. In terms of what that means for this earnings season, right, I think that these are the EPS expectations or consensus for the last 3 months of 2022. There may be some change in that, of course, given the actions that some of these companies have taken. But you and I talked 24 hours ago. We're probably coming out of an earnings trough when we get reports for the final 3 months of 2022. Beyond that, I think we're asking ourselves what the sort of longer term and health of this industry is. If not an economic recession globally, what does an earnings recession look like? And without these actions, can you cut your way out of an economic downturn? That really is the question for Silicon Valley and global tech right now.
The news this morning is Microsoft. I want to just sit on Amazon a little bit longer. Yeah. This is a company in 2019, as you know, had just short of 800,000 employees. A couple of years later, it had 1.6 million. It's come down since then, but I just wonder, Ed, does 18,000 get it done for that company, given the challenges that they're going to face?
Yeah, you look at the commentary from Andy Jassy. He's talked about how Amazon has survived economic downturns in the past, and they'll do so again. 18,000 jobs is the biggest cuts that Amazon's ever taken. The other way I'd look at it is that this is Andy Jassy kind of unwinding some of the pandemic-era investments that Jeff Bezos made, right? They invested billions of dollars to increase their fulfillment capacity, hired many workers just to handle that pandemic-era demand. That's not there anymore. You know, the movement of packages and goods, particularly in North America, is just not at that same level. So it's an unwinding of a base that's no longer required.
Ed, thank you, mate. Looking forward to the coverage of the earnings over the next couple of weeks, starting with Netflix this week, then on to Microsoft next week, then early February, we'll hear from Apple and all the rest. Just getting some comments from the St. Louis Fed President, Jim Bullard, non-voter this year on the FOMC, but a lot of people still follow his thoughts. He's speaking at an event held by the Wall Street Journal. He says his 23 rate projection in December was for 525 to 550. policy. Went on to say policy is almost restrictive. You've heard that phrase a few times in the last month or so. Are we at sufficiently restrictive rates? It's not quite there yet, is the takeaway from Jim Bullard. We need rates above 5% to continue to push inflation down. He wants Fed policy to err on the tighter side as insurance. So the decision, and I guess the challenge we're all facing this year in this market, are we trying to price in a growth slowdown off the back of monetary policy tightening and a Fed that's trying to get sufficiently restrictive? Or are we trying to price in a global growth recovery off the back of China reopening? This is what PIMCO's Erin Brown's got to say on the matter. China's reopening should drive out performance this year in China. This will also help European equities. US stocks with international exposure should outperform more domestically oriented stocks, particularly as the US enters a recession. This favors US large caps over small. Erin, I'm pleased to say, joins us right now. Erin, fantastic to catch up with you. Let's talk about the gains we've already had. Big gains in Europe, big gains in EM, big gains in parts of the Chinese equity market. Why do you think these tailwinds are strong enough to overcome some of the headwinds out there?
So overall, I still am fairly pessimistic on the overall outlook for equities, but I think that there's going to be pockets of growth that should outperform. And I think you're going to see more differentiation this year versus what we saw in 2022. And so specifically, I think that those names that are really geared towards Asia and the China reopening story are going to be the places that are going to outperform and where you really want to hone in on your bets. And so there are names in the US that I think should do well. Some of the luxury names, specifically, geared names to international travel, and some of the hotel and leisure names should outperform. And then I even think some of the tech sector should also start to do well, particularly given the fact that duration we're now starting to see, or rates are starting to move lower. That should help to support, those long duration bets in the technology sector. And I think that you'll start to see those names do better. So anything that's really geared outside of the US, which have more of its sales and revenue streams from international exposure, I think are going to outperform the US as it heads into the recession.
So 3 buckets there: airlines, potentially; luxury, potentially; and then you've got US tech on the third point. I want to get to US tech in just a moment. Can we talk about the airlines first? Airlines year to date: United up 37%, American Airlines up 37%, JetBlue even up 31%. I'm not sure about their international exposure. So Erin, that raises the question: is this a flash in the pan, a bear market rally? What is this on the screen?
Yeah, so when I talk about travel, it's not just airlines. It's some of the more hotel and leisure companies as well. And I really look to those with more international exposure than the U.S. airlines, which I think are experiencing a little bit of a bounce just given the strong demand and sort of, that we saw, throughout the end of last year, as well as how well they've operated, despite challenges in the second half of last year. But I think when you really want to focus on is more of the service-oriented and leisure-oriented travel names and hotel names outside of just airlines.
It's the luxury players as well. The luxury players absolutely flying. You mentioned that. LVMH up 18% year to date. Hermes up by 15, 16% year to date. Kering up by about the same amount. Kering up by 15% as well. Year to date, I keep saying year to date. Can we just remember it's January 18th? So year to date is just a couple of weeks. Erin, the one thing I wanted to discuss with you as well is tech. So Microsoft just come out and made its job cuts. Could be in and around 5% of the company. Guggenheim downgraded the stock yesterday. And I want to talk to you about this quote from them. They said, while most investors see this name as a large, stable business that can weather any storm, it does have vulnerabilities, some of which could be exacerbated by the macro slowdown. We are in a prolonged macro slowdown and no one is immune. Erin, can you just walk me through your expectations for this recession in the United States and how it stacks up with maybe part of the equity market, part of the tech sector that is more cyclically challenged than some people might appreciate?
So I think that's right, but I think that played out through most of 2022, and you saw material underperformance of the tech names on the back of, first, a slowdown in overall demand, and secondarily, higher interest rates. And now we're starting to see that a very, much more severe slowdown is priced in the tech sector versus what we're seeing across other cyclical sectors. And in addition to that, we're now seeing duration or treasuries stop increasing in terms of rate level, and we're starting to see them actually rally and yields go back down lower. And so I think just given the fact that a pretty severe outlook for revenue growth is already priced into many of these names, and the fact that we're starting to see duration start to move in favor of treasuries, or move in favor of the tech sector, I actually think that the tech sector is one of the few sectors that is really discounting a recession in its outlook.
So yields have been coming down recently. They're down again this morning. I've got the 10-year down 16 basis points. I just wonder, I've asked this question a few times this week, Aaron. I'd love your view on it. For the same reasons we're bullish on the global economy, relatively speaking, off the back of this China reopening, aren't they also reasons to challenge this view that yields should go lower?
Well, I don't think that we should be necessarily bullish on the U.S. outlook for the economy for 2023. I do think that the U.S. is heading into a mild recession or moderate recession throughout the course of this year, and we've seen it in the numbers this morning.
Yeah.
That should give pause to the Fed interest rate hiking cycle after, the next couple of meetings. And so I do think that, we'll likely see 50 basis points more of rate hikes, and that should be the end, absent, a significant spike in inflation. I think that the market's largely discounted that the rate hiking cycle, and as we start to see inflation move lower, as we saw again this morning with the PPI print, I do think that you'll likely see rates move lower, and the expectation that the Fed is done. And that, I think, is what's sort of underpinning some of the optimism, at least that I have, for the tech sector and for any, interest rate sensitive sectors.
Sure, just to be super specific, though, on what I meant by what this could mean for the bond market, we're pricing in a global recovery off the back of this China reopening. That's reflected in what we're seeing in the luxury names, reflected in EM, reflected in European equities. And I'm trying to wonder how much of a factor that will be in the US bond market. So in the Treasury market this morning, we're responding to softer data, Treasuries up, yields lower. But if we're also pricing in a better recovery abroad, driven by China, what do you think that ultimately means for the trajectory of bond yields?
So I actually don't think it means that much. I don't think that you're going to see large economic spillover effects from China to the rest of the world. You'll see it in certain equity sectors, but it's going to be very specific. And what I think is different this time around than what we've seen in past, significant sort of rebounds in China is that historically the rebounds in China have largely been driven by big industrial production gains, which were felt from a ripple effect perspective, across emerging markets, across commodity sectors, across, more cyclically oriented sectors. This time around, I think the reopening is going to be very specifically limited to China domestically, and to China demand for more service-oriented goods. And so as opposed to when you've seen it in the past, which were more industrial-led, this time around it's going to be more consumer-led, and it's going to be really geared towards travel, towards leisure, towards some luxury goods spending, towards getting back out in the world. And so I think that differentiation is going to have a materially different impact in terms of what, sort of the ramifications to the rest of the world. And you're probably not going to see the same growth impulse stimulus that we've seen in the past in the US, in Europe, in, the rest of the world.
Interesting. Aaron, great point to leave it on. Just fantastic, as always. Aaron Brown there of PIMCO on the latest. Here's the latest on Microsoft. 10,000 jobs to go. The stock is just about unchanged on the session. Dan Ives of Wedbush, bullish on the name, said this is a rip the Band-Aid off moment to preserve margins and cut costs in a softer macro, a strategy the street will continue to applaud as management teams navigate this Category 5 near-term economic storm. Category 5 near-term economic storm, and 10,000 jobs to go at Microsoft. More on that through the day on Bloomberg TV and on Bloomberg Radio. Coming up, the US and China pledging to talk more.
These meetings are critical. I mean, these are the two largest economies in the world. It's important for the rest of the world that they work closely together.
We'll catch up with AMH down at DC next.
Special Wall Street Week from the World Economic Forum in Davos, Switzerland.
This is Bloomberg Wall Street Week. I'm David Weston.
Join Bloomberg's David Weston as he engages with the foremost business, political, and cultural leaders for discussions on wealth inequality, global power dynamics, and more. Accountability, solution-driven conversations, data insight. This Friday at 6 p.m. Eastern, only on Bloomberg Television and Radio, your global business authority.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
China has shifted economic policy, no more bashing tech companies, no more 3 red lines for property developers, and they're pulling back on their wolf warrior diplomacy, reassigning the wolf warriors to some, godforsaken place to do nothing. So this is a sea change in China. China is going for growth. They have the ability to do so.
It's a shift in tone. Will it lead to a shift in policy? US-China talks picking up in Zurich. Secretary Yellen looking to alleviate tensions in a meeting with her Chinese counterparts, saying we share a responsibility to show that China and the United States can manage our differences and prevent competition from becoming anything ever near conflict. The Vice Premier of China echoing that sentiment, saying no matter how circumstances change, we should always maintain dialogue and exchanges. AMH joins us now in D.C. Anne-Marie, did we achieve anything with this?
We achieved words, Jonathan, warmer words between these two countries, between Washington and Beijing, but obviously no serious policy breakthroughs. There's a number of very high contentious issues on both of these individuals' agendas coming into this meeting, whether it's trade and technology. Obviously, there's massive disagreements between China and the United States when it comes to things like Taiwan and Ukraine, and also debt sustainability. And this, of course, comes before Secretary Yellen heads to Africa, which is going to be a major part of her discussions there. There's one key thing, though, Jonathan, and this is more of an openness for that engagement to continue. And when you look at the Treasury readout, the last sentence, it insinuates that Secretary Yellen will be heading to Beijing. It says she looks forward to traveling to China and to welcoming her counterparts to the United States in the near future. So not just Yellen going to China, we also heard yesterday from the State Department, Blinken, that very much so trip that we've been expecting. We now have it. It's going to be early February. So you do see the dialogue warmer, but not the policy stances.
Abroad, maybe, perhaps not at home. So we've got a conversation abroad about debt sustainability. We're doing the same thing domestically. The debt ceiling deadline approaching on Capitol Hill. The House Speaker, Kevin McCarthy, weighed in on this. Take a listen.
What I'd like to do is I'd like to sit down with all the leaders, especially with the president, and start having a discussion. Why wouldn't we sit down and talk, and especially with something as serious as debt, but as serious as a debt limit? Why would you want to wait till the end? I don't see why you would continue the past behavior.
Does the president want to sit down with him right now, Anne-Marie?
Well, the president has said that he is willing to work with anyone. The issue the White House is taking is the fact that they do not want to make a single concession when it comes to the debt ceiling, because they say these are debts that are paid for past legislatures. These are past Congress decisions, and that the United States is not going to pay fast and loose with whether or not they can pay off their debts. So right now, Jonathan, you have just a classic standoff, which we've seen in the past. The issue, and what people are starting to get concerned about, a la 2011, is potentially a downgrade because it's going to come so close to the brink, because what we've already seen from this Congress, which is the fact that a few people can take control, especially when they couldn't elect a speaker.
In a major way. AMH, thank you. Down in DC, thank you very much. Just to get you up to speed, equities look like this, up 0.4% on the S&P, on the Nasdaq, higher by about 0.8%. This rally in the bond market, off the back of weak economic data, the rally in the bond market continues, down 11 basis points on a 2-year to just north of 4.1%. Your 10-year, 433 back in October. Right now on the 10-year, a break of 340. So we're in the 330s now, move of almost 100 basis points. Up next, your trading diary.
The satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
Minutes into the session, just about firmer by 1/3 of 1%. Really impressive rally taking place in the bond market off the back of less than impressive economic data this morning. Downside surprise on retail sales, on industrial production, and inflation coming in a little bit softer, encouraging some of these moves as well in the bond market. That's the price action. Here's the trading diary. The Fed's beige book, 2 p.m. Eastern. Fed speak picks up with Harker and Logan on deck. We'll hear from Collins, Brainerd, Williams all on Thursday. Another round of jobless claims in the morning. Netflix kicks off big tech earnings in the afternoon. Finally, we close out a week on Friday with existing home sales. From New York, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. This is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close. Welcome to Bloomberg Crypto.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it.
Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns.